Catherine Coleman, and I'm with CAP-OC, and we might have two others on here. I don't see them yet, but
Okay.
I'll be joining you on your Saturdays. Thank you.
And where's your office? I know you're probably working virtual these days, but where's your office located at?
Hi, good morning. So my name is Laura Dame. I am a family support advocate at Anaheim Independencia. We are an off-site family resource center. We're part of CAP-OC. And Carolyn is in the main office. She is off of Monarch in Garden Grove, and I'm located in Anaheim.
Okay, very good. Thank you. All right. Anybody else from KPOC that wants to introduce themselves?
Do we have any other? I don't see them.
We're going to be having Cassandra. She's also from the Anaheim Independencia Family Resource Center, and our site manager, Jessica Bayo, but they will be joining in shortly.
Okay. All right. Thanks. And then we know that Fred Ramos is on the line. Anybody else from St. Killian's that wants to introduce himself as far as the leadership team?
Yes, Jerry, this is Fred, St. Killian team. We have, of course, in the core member that we have there, we have Steve. We also have Mel Alponte. We have Evelyn Arias. We have John Nagy. Maybe they can introduce themselves as well. And Art Leoncio, the core team leader, St. Killian. And I also work for the IRS, Fred Ramos.
That's right. Fred does work for the IRS. That's right. Okay, great. All right, and then for the new folks, you may have heard my name or you may have seen me in a meeting. My name is Jerry Muir. I used to work for the IRS. I retired, and then I became an enrolled agent, and I also retired from the military. So I do have that background, especially for those folks who end up certifying on the military module. I actually teach a class at Coastline Community College, and it's called the Vita 1 class. And we're going to teach it again in January. And that particular class, we take our students through the basic, advanced, and military modules, and we do that in about 3 or 4 weeks. So if you're remotely interested, you'd have to register, and I think it's 40, 50 bucks. You gotta pay for the tuition. There's no books required because in that class we use the publication 4012. All right, so here we go. So this is very similar to last week, and I just wanted to remind everybody on the call, there's an enormous amount of IRS publications and forms out there, and I know that our go-to document is a volunteer resource guide. What I've done over the years, of course, I use that 4012 heavily during the season, and then I also dig down into other publications. And I must say, every time I open up an IRS publication, I learn something new. And these publications, a lot of them are revised yearly because obviously it changes in the tax law, court decisions, and things like that. Your publication 4012, if you don't have one, they're available for free electronically on the IRS website, and that would be for tax year 2020. And the same thing with the Form 6744, the assisters test and retest, that's available electronically for free. All these documents are available for free. I have gone on to the Franchise Tax Board website many a time recently, and for some reason, and I don't know why, they've changed their rules. It's a little bit more difficult to get Franchise Tax Board material. They'll either email it to you or send it to you, but it's not like the IRS, a couple clicks and you have it downloaded on your computer. But nonetheless, you can still get them. You just have to jump over a couple of hoops. Other documents, when we mentioned this before, I've had taxpayers ask me, Jerry, why do I have to pay that tax? How's that calculated? And I used to tell them way back in the day, I said, well, it's the computer does it. And they go, well, can you show me? So then what I would open up the instructions to the Form 1040, and I would explain to them that this is your gross income, this is your filing status, and this is your age, and this is the tax for that particular taxable income. And what it does, it educates them, educates me, and it gives people confidence that obviously the program's doing the right thing. I haven't seen mistakes with tax software, at least not the Tax Slayer program when it comes out. But I have seen programs, or excuse me, I have seen mistakes with other programs. And so what I've done, I had to call the programmers and say, hey, you got a mistake and you want to fix the mistake. But Tax Slayer, I've never seen it. And if you've seen the mistake, I know you want to bounce it up to Annette Barcelo or a representative with the IRS. But again, Tax Slayer, I haven't seen it. Another publication I rant and rave about, I think it's a great publication, is the publication 525, and that's taxable and non-taxable income. I've used that many times at Vita sites where people will show up and say, Jerry, I got this particular document from this particular entity, information return, and they'll say, is it taxable or non-taxable? And my response would be, I don't know. Let's look it up. And that happens a lot. And so again, that's a great publication. And then when you're working with taxpayers who are self-employed, they could have a business where they're generating perhaps maybe $10,000 or $15,000 of net income. That publication 334 from the IRS, the tax guide from small business, it does talk about income, it does talk about deductions, and it also talks about credits, and then record keeping requirement. And again, that's a document that taxpayers can download, and it's very helpful, especially if you're just getting started in your small business. Very helpful. And then I know there's a few people on the call. John, I'll pick on you. If I remember correctly, you're an enrolled agent, and so if you want continuing education credits through the Vita program, then you would reference the publication 5362. And also, if you're a member of the California Tax Education Council, you can get continuing education credits. And then I think we have a couple of CPAs on the call. Same thing, they can get those credits. And then Fred, if you're still on the line, if I understand things correctly, once everybody goes through training at St. Killian's, are you the guy that signs off on the 13615? You still with us, Fred?
Hey, Fred. Yes. This is Steven. I have to answer for him. Yes, and he is the one who's going to be signing that that form.
Okay. All right, very good. And then again, the Form 540, we're going to talk about that in a couple weeks. And I think the key here is, again, we're kind of covering the same ground, but reinforce it. The Form 3853 in California started on January 1st, 2020. You either have to have health coverage or you have to have an exemption. And if you don't, then you're going to pay that individual share responsibility payment. And as I mentioned last week, I did a scenario where I had a couple who were filing joint and they had about $60,000 of income and they did not have coverage and they did not qualify for an exemption. And their individual share responsibility payment was $1,500. So that's a big deal. So that's part of the education campaign where we're going to educate taxpayers that they want to get insurance. And if you have a low income individual in the state of California, there's a number of programs where they can qualify for health insurance. All right, and any questions about these publications before we move on? No? All right, then I've got a question for, how about, is it pronounced Vani?
Yes.
Vani, have you seen the intake and interview sheet this year, the brand new one?
No.
You haven't seen it?
No.
Okay. So that's something we definitely want folks to take a look at. We'll probably download that probably next week and go through that in detail. But the intake and interview and quality review sheet, we all use it for our taxpayers. And typically it starts with that screener. The screener will have have a short discussion with the taxpayer, and then the taxpayer fills that out. And a lot of taxpayers, they'll mark unsure. And so what we do in the training is we do that follow-up interview, if you will, where we're asking questions so we can go ahead and perfect the 13614C. And then that way we can prepare a correct return. And what I do when I interview taxpayers after they fill that out, I'll make notes. There's no law against making notes on the intake and interview sheet. And it's important to put as much on that document to help out the preparer, whether that be you or someone else. And then for the new folks, if we have any new folks, the 13615, that's your volunteer standards of conduct. That's something that will be automatically generated in the Link and Learn program after you certify. And then what you'll do, you can go ahead and you can print a copy for yourself, or you can go ahead and download that and then provide that to your site coordinator for St. Killian's. That most likely would either be Fred or one of his leadership teams. Okay, so let's go ahead and talk a little bit about TaxSlayer Pro. And if you have gone on to TaxSlayer Pro recently, the 2020 tax year software is available, but here's the caveat. Caveat is, at least I could not turn it into a PDF and download it once I completed a return. Another caveat is state returns are not yet available. And then yet another caveat, when I prepared the return, a 2019 form was generated. And so, again, I'm not poking fun at the people who put this together. I think the term is it's a work in progress. And so what that means is I would recommend don't get frustrated, use it. If you don't want to use it, then you can use the 2019 and you can continue to practice until the full-fledged 2020 is up, where you can go ahead and prepare a return. But again, it's available, and keep in mind there are a number of tax law changes, so you'll see those on the form 2020 when it finally does generate. And then the practice lab, I've done this a couple years. There are a number of tutorials on the practice lab, and you can spend a lot of time looking at those tutorials. So if you're new or fairly new, or if you're like me, you forget stuff and then you start the season again and say, okay, how do we do that? Those tutorials will walk you through, and they're actually a little bit better than a couple years ago. A couple years ago, there was a very smart lady who was doing the tutorials, and she spoke at a rapid fire pace, and it was very difficult to keep up with her. She slowed her rate of delivery down, and I think they're pretty good tutorials. So that would help you out, again, if you want to review those. And then next in the practice lab, you have practice returns. I believe there's 7 of them the last time I counted. One is married filing separate, which I wouldn't recommend you do, because in the California Vita program, and my understanding for AERP also in California, we don't do married filing separate. And then of course, in addition to those practice returns, you have solutions. So that would help you out if you want to, let's say you get together in a small group, you're doing some additional training. I've used those and they're pretty good. Keep in mind though, those practice returns deal with taxpayers who are usually based in Georgia, because that's where TaxSlayer comes out of. And so if you want to modify those for your teams or your groups, you can do that. But again, they're there and available for use. Okay, any questions about the TaxSlayer program before we move on? And do we have any brand new volunteers who have not been in the Vita program before? Can you raise your hand so I can see how many new folks we got? If we have any new folks. All right, looks like they're all returning.
Hi, I'm Julie. I'm from AARP, and we're going to be doing Vita.
Okay, and Julie, are you new to AERP and new to Vita?
No, I'm just new to Vita. I've done ARP for a couple of years, probably 4 years.
Gotcha. Okay, then you got a lot of great experience then.
Okay. And this is Carolyn from CapOC. I'm basically new to Vita.
Okay, great. Well, obviously there's Carolyn, there's a lot of material, and some people, they're very excited about it. Others are scared, but I'd recommend, you just go through the training. I recommend spending a lot of time on the publication 4012. And then when you open up that practice lab, that professional software, you bounce around and you hit the tabs. And that's one way to learn. You could spend many, many hours in the practice lab. And I will share this one story with you. My wife, she's never taken an accounting class. She's never taken a formal tax class. And she has not taken any finance classes. She is a master at that software, because what she did for a couple of years, she was a site coordinator. And she spent a lot of time in that software, and she actually knows it better than me. She should actually teach this class. And so again, if you spend time with it, it's like anything, you're going to get very good at the practice lab. Okay, let's talk. What's that?
My name is Margaret, and I'm new to Vita.
You're new to Vita, and what organization are you affiliated with?
I joined the Vita Club at my high school.
Oh, you're in high school?
Yes.
Fantastic. Yeah, in the Vita program, I actually read some material recently. There's no minimum age for the Vita program, but typically most entities they'll ask the students to be about 16 years of age. But that's great. This is going to give you a leg up on the other students. And then if you decide to become an accountant or get into finance, it can only benefit you because you're not only going to learn about tax, you're going to learn about interviewing people. You're going to learn about reading documents, and in some cases, reading contracts. So this is great for you. What high school, by the way?
Sure High School,
And what city is that located in?
Montebello.
Okay, great. All right. Okay, well, welcome aboard. So let's jump into some selected income topics. And one thing you do see at the Vita site, and you certainly see these at the AARP sites, are Social Security benefits. And Social Security benefits, typically you're talking about someone who's retired. Typically they're 65. They could be younger. You've got U.S. government employees, when they retire at 56 or 57, there's a special program they can start receiving Social Security benefits. But typically it'll be someone who's about 65, typically. That SSA 1099, that's an information return from the Social Security Administration that beneficiaries receive. And if someone does not get the SSA 1099, then all they have to do is contact Social Security. If you've never been to a Social Security office before, I got to tell you, they do some great stuff. I've gone there on behalf of relatives, on behalf of myself, and they will be able to get you that SSA 1099 pretty quick. And then also, if you've never been on the Social Security website, Social Security Administration website, you can actually set up an account, look at all of the Social Security tax that you've paid, all of your income for the last, let's say you've been working 40 or 45 years. It'll be there in a statement that you can download after you've set up an account. And also it'll give you information about your estimated benefits. And so it's a real good website, Social Security Administration website. And then if you're a geek, then you can get into a number of things to include what is called a trustee report. They have an executive summary, and then they have a voluminous document, many pages that talk about the Social Security benefits and the Social Security system. So that's really helpful. A lot of people, they have misconceptions, they have myths about Social Security, and that website, they do a very good job to debunk those myths. Okay, another publication, I've used this from time to time, especially when I was working for the IRS, and it's the publication 915 talking about Social Security benefits. And one thing I've seen, you're probably not going to see this a lot, but you're going to see it enough where you're going to say, okay, I'm going to go ahead and dig into this and see if I can understand it a little bit better. When somebody receives Social Security benefits, typically what you have is for tax year 2020, they're a recipient, they qualify, they've applied for it, and they're receiving their benefits, and they get that information return, the SSA 1099. So what happens is they're going to report that income in the year that they received it. And that makes sense. Well, let's say you have someone who has applied for Social Security and perhaps maybe 2 or 3 years go by, and then all of a sudden Social Security says, okay, you are eligible for benefits, and because you applied back in 2018, then you have essentially retroactive benefits from 18 and 19, and then your current benefits from 20. Well, what you have to do, of course, is you've got to report those benefits. And that is a lump sum payment, which includes multiple years, 2 or more years. And so what you can do is you can dig into the publication 915, and there are worksheets on pages 16 through 19 that talk about how to handle that lump sum benefit. And I'm going to go ahead and read this directly from a text that I have. And so you have at least a basic understanding of the lump sum. It's called the lump sum election method. And so what that means is you get your SSA 1099 with multiple years. You can simply report it as it's shown on that document, or you can elect, which means you can choose to take a lump sum election method. So what you're doing, you're basically refiguring what is called the taxable part of benefits for each prior year using that year's income. And so what that means is you're going to report obviously your amount that you received in your 2020 return, but you're going to go through a calculation where you might pay less than what you paid if you simply reported the regular method, i.e. you simply reported what you received. I've seen that a couple, 2 or 3 times. And again, when you see the SSA 1099, it'll clearly state what years the benefits are for. And then at that point, you might want to ask the taxpayer, hey, taxpayer, do you want to go ahead and use the regular method or the lump sum method? And most taxpayers will say, what? And so then what you can do is, and I would encourage you to review the worksheets before you start working at the Vita site, so you have an understanding. Going through those worksheets and perhaps maybe some examples, you will master the lump sum payment. And so when you bump into that, you don't have to stumble around the software and jump into the publication 915 to try to figure it out. You want to do it in advance. And it does take a little bit of time. We're not going to do it here. That's well too much involved. But what it is it's a notification to you that is available to the taxpayer, the lump sum method or election. Okay. And I know AARP gets a lot of people with Social Security, and I don't know if AARP gets a lot of people with lump sum. So I'm going to ask an AARP representative to tell me if they see a lot of lump sum payment.
I think I've seen one.
You've seen one?
Yeah.
I've never seen any.
Okay. Yeah, I think I've seen maybe 4 or 5. And I guess it looked this way. If someone has it and you've got the knowledge and you ask a few questions, if you can save that taxpayer $200 or $300, it may not be a big deal to maybe you, but it's probably a big deal to the taxpayer. So again, I just offer that. I've seen it, and it's out there. Okay, moving on. Retirement income. We have a lot of retirement income at Vita sites. I've seen a lot of this at the site that I work at in Garden Grove. I've seen this at AARP sites. So what happens is people retire, and typically they're going to receive an information return, a form 1099-R. And that's for a lot of things. Typically it's going to be, of course, you have different types of retirements. You have retirements that are called defined benefits and defined contribution. A defined benefit would be something like I've got. I retired from the IRS, and so I get a certain amount of money each month based on the number of years that I worked. Or maybe you have a military retirement. That would be a defined benefit. You work so many years, you're at a particular rank, and you get so much per month. A defined contribution would be like a 401k or a 403b or a 457. And those 4 numbers that I'm using, that's all based on, if you get into the Internal Revenue Code, those are those qualified retirement plans. And so what that means is when you start taking money out, you're going to be issued that 1099-R. And we also have IRAs, individual retirement arrangements. They used to be real popular many years ago. I don't see them a lot, but they're out there. But the bottom line is someone retires, they're going to get the 1099-R. And then we've talked about this before. Some people say, I did not receive the information return from the company that I should have got the return from, or the entity. And I always tell people, you should go back to that entity and ask them for that information return. If it's incorrect, go back and ask for a corrected one. And if that doesn't work, the company shut down, they've moved, someone's died, then you want to call the IRS. And typically you're going to be able to get the data that you need, the information that you need to file a tax return. In those rare circumstances where you simply can't find or obtain an information return, then if you have gross income and you have a filing requirement, then by all means file it. Now, Fred, I don't know what you do at your site, but at my site, when people show up and they don't have it, we attempt to secure that information return for them. And if we're unsuccessful after a number of weeks, I tell them, hey, you got a filing requirement, sit down, we're going to file your return as best we can. And that does happen. And then here's something that, and if you have your publication 4012, I would ask you to open it up right now to page Delta 37. And Delta 37 is a page that talks about the simplified method. And I want to talk about that because if you take the advanced certification, you're going to bump into this. And when you're dealing with taxpayers at the Vita site, you're going to see this from time to time. So you want to have this awareness. And so what happens is retirements, when you have again, we have defined benefit, and then we have defined contribution. With defined benefits, sometimes the individual, the employee, they've contributed to that particular pension plan. And I don't know how many pension plans are around the United States, but in the years that I've been working in tax, I've seen literally hundreds and hundreds of different types of 1099-Rs and pension plans. But when people have basis or cost of their pension, they've contributed, then what happens is when they start receiving their distributions, they receive a portion of that basis or contribution, which is non-taxable, because essentially they put money in. It's kind of like when you go to the bank. You make a deposit to your bank account and then you decide to close your account. You take the money out. That's not taxable income. It's a return of capital, a return of principal, something like that. Same concept with a pension that you've contributed to. When you receive that contribution, again, that's not going to be taxed. And you're going to see that from time to time. And I love this story that happened, although it was difficult for the taxpayer, but we got through it. A couple, 3 years ago, I was working with a student at one of our sites, and he had prepared the return, and I was the quality reviewer, and I came by and I asked the taxpayer, I noticed you got a plan. It's one of these really old plans. You started working with the company back in the 60s. Did you make any contributions to your pension? He goes, yes, I did. I said, okay, well, that's going to make a difference. How much was it? And he said it was to the tune of, I think it was $80,000 or something like that. It is a lot of money. I said, okay, well, then we have to stop what we're doing because you've made contributions, you've got basis in your pension, and that means your distributions are going to be non-taxable in part. And then if you go to your page Delta 37, where it says Simplified Method, this is what you're going to do. You're going to open up the software, and we'll show you this after the break. You're going to open up the software, and you're going to key it as you see it. And when the software says, do you need to use this particular worksheet, you're going to open it up, because what you're telling the computer, this taxpayer has cost or basis in the pension, and that recovery is going to be non-taxable. And you can see on page Delta 37, it talks about plan cost at annuity start date. And that means how much you contributed. It talks about the start date of the annuity, and that means when they started receiving it. Death benefit exclusion, I haven't seen that, but it's there, you can read about it. And then they ask about the age of the recipient. And then they talk about a joint or survivor annuity. The joint survivor annuity means you sign up, like for example, I've got a joint or survivor annuity. And so when I check out, my wife is going to get a portion of my IRS pension. And so you want to put the age of the recipients, and you want to follow the instructions. And then number of months paid in 2000, and in this case, it'd be 2020. And so you want to put that in. And the amounts previously recovered, that means if they have filed returns previously and they recovered a portion of that contribution, you want to plug that in there. You don't see this a lot, but when you do see it, it makes a difference. And the bottom line is that recovered portion is not taxed. And you're going to see that. And so again, you want to follow that. And that's still in the advanced certification. Okay, any questions about the simplified method or cost or basis in a pension?
I have a question.
Okay.
On the taxable amount, which is 2A, it's a unknown. So what do I supposed to do when it's a unknown?
Yeah, we're going to show you. We're going to go into the software. We're going to click where it says go to the simplified method worksheet. That's what you have to do. And then you have to tell the computer, we're going to give you all the data with this taxpayer, and we're going to see the amount of the taxable portion of the 1099-R.
Okay.
I have a question also.
Okay.
On the simplified form, the box that says amounts previously recovered, that is a big unknown.
Yeah, and you know, this goes down to, you try to help people as best you can. I've seen this many a time where taxpayers, they kind of throw their hands up and say, I don't know. And I tell them, well, if you want to go ahead and do the research, the investigation, and the digging to figure it out, okay, you can bring documents, we can take a look at it. Your tax returns are probably going to be the answer. But if they simply don't have it and they're not willing to do the digging, then the answer would be 0. And I've had taxpayers who tell me, Jerry, I just don't want the hassle. I'm thinking, well, okay, it's your money. I'm going to do what I can to help you out, but you're the one who's got to start. You got to start the journey. So that's my answer. And sometimes, it's sometimes people just don't want to help themselves. I got it.
And note that it's amounts that could have been recovered. They don't actually have to recover it, so you can calculate it.
Well, like I say, there are ways to do it. Yeah, look at your fact pattern. But again, I'm sure in my experience, most people, what they'll do, they'll have their tax return, and that'll be the answer. But the ones who don't, then you got to do the digging, but they got to help themselves out. Okay, let's move on to qualified charitable distribution. I've only seen this in tax material. I've never seen it in real life. I've been told that it does happen at St. Killian's, but what that means is you've got some type of qualified plan, and instead of getting a distribution and a check in your hands, what you decide to do, you decide to donate that money directly from the trustee to the charitable organization, the qualified charitable organization. And if you choose to do that, then what happens is you're not going to take a charitable deduction on your Schedule A, but that distribution that you take is going to be non-taxable to you because it goes directly to a charitable organization. And again, I have never seen that on a tax return, but I've been told St. Killian's has that.
Jerry?
Yeah.
I do that myself personally.
Oh, tell us the story.
It's a wonderful thing to do because not only does it mean that you do not have to declare, like for instance, if you have to take a mandatory requirement, IRA withdrawal, and instead of having them send you a check, you tell them all the various, whatever charitable institution you want them to send it to. They have to send it directly from them. Then you can deduct whatever that portion is from your distribution. So then it's non-taxable, but it also, because it lowers your taxable pension, it also lowers what portion of your Social Security becomes taxable. Because sometimes Social Security, as you know, a portion becomes taxable because of the total income. So it makes a huge difference. I am a big fan of it. And I tell everybody I know that has to take a distribution, if you make charitable distributions, do it that way.
Very good, very good. So we have a live example then. All right, great.
Hey Jerry, there's a question there. It's in the chat. Someone is asking to clarify that the method that you're just explaining only applies to after-tax contributions, and because many people have a 401k pre-tax contribution, and those will be taxable upon distribution. So
I'm sorry, but that's this is on after tax or mine, for instance, is a pre-tax. I mean, it was tax after I made the donation. Okay, let me start back. The IRA, or I had a 401k. My contributions to the 401k were not taxed at the time that I made them. Then when I get the distributions now, they become taxable. But if I make this qualified charitable distribution directly from I use Fidelity, then they are not taxable.
Yeah, hi, Julie. This was my question, and it isn't about charitable contributions. It's about the previous discussion on simplified tax.
Oh, okay.
And what's your question about the simplified method?
It's not a question. I just wanted to make sure everybody was clear that only applied to after-tax contributions to a plan. If they're using pre-tax withholding into a 401k, then that's not going to fall into the simplified method.
That's true.
That is correct, because the 401k is tax deferred, and when you take money out of a 401k, it's a fully taxable event. Okay, great. All right, and who was that person who made that comment?
It was Sean.
Sean, okay, thank you, Sean. Are you with, I think I've met you, you were St. Killian's,
St.
right?
Killian.
Yeah, we spent many days in the rain together last year.
Oh, how exciting. All right. Okay, moving on. So we have other income, and you will see this from time to time at your Vita site or your AARP site where you have people who have cancellation of debt. And there's different types of cancellation of debt. One of the more popular ones I've seen is people who have credit cards and they're either unable or unwilling to pay that debt. So eventually what happens is that credit card corporation then will cancel the debt. They'll take some type of benefit on their corporate return, and then they will send an information return to the taxpayer, a 1099-C, and that cancellation of debt for most of your taxpayers is going to be a fully taxable event. Now, there are exceptions to that, and you're not going to deal with the exceptions because they're out of scope. One exception is bankruptcy, and the other exception is insolvency. But when you hear that term, maybe you might want to educate your taxpayers. Insolvency simply means you have an individual that has negative net worth. And if they have negative net worth before the discharge, then the discharge is not included in income. But again, that's on a credit card. And then another one, this is one of the extenders, and this is something I think if you're going to tackle this, you want to have some additional training, you want to review the material, and the materials include, this is called the Qualified Principal Residence Indebtedness. And what that means is you have an individual that has a loan, they've used the loan to purchase a personal residence or a principal residence, and then what happens is they lose their house because they either abandon the house or the house is taken from them during foreclosure. And if that's the case, then they may qualify for this particular relief. And what that means is when you have your home taken from you or you abandon it, two things happen. You're going to have some type of discharge of indebtedness, i.e. cancellation of debt. And then you also have disposition of your residence. Your residence, your personal residence, is a capital asset. And when you have a disposition, which means you relinquish title, then you have to determine whether or not you had a gain. We know that losses, if you've been in the program before, losses on a personal residence are not deductible. Gains on a personal residence, you have to report on a tax return. And then we're going to talk about, obviously, the exclusions on that. But again, if you have something like this is something you don't want to tackle if you've never tackled before. Work with someone who's got experience and spend some time in the IRS publication 4681, which has a lot of good examples about foreclosures. And so again, when people go through foreclosure, it's a traumatic experience. And what happens is they may have cancellation of debt, and they may also have gain on the sale of, disposition of the property. So again, that's been around for a number of years, and then it went away, so to speak. I've seen it a few times on returns, but again, the 4681 has some great examples. And then in your textbook on the extender tab, it has some examples on how to treat what is called qualified principal residence indebtedness. All right, and I'll throw this out. Do you guys, at your Vita site or AARP site, do you see a lot of cancellation of debt?
I've seen a fair amount at St. Killian.
Okay, is it mostly credit card?
Yes.
Okay. And that's in it. I've seen it before. People are very frustrated. They go, "Why do I have to pay?" And we explain to them, well, when you borrowed the money or you charged up your card, you had some type of economic benefit that was conveyed to you. And Congress says if you've got an economic benefit when you have your credit card, and then you don't pay it back, then it's going to be taxable in most cases.
Hey, Jerry, this is Sean. Another time I've seen it is on the death of a taxpayer, because if they have any remaining credit cards, those probably all get charged off, and then their spouse gets a nice surprise at the beginning of the year.
Yeah. I've seen that too. Okay. All right, and we will take a break in a couple minutes here, but let me see if we have yeah, I can get through this and we'll take a break. Also, I see a lot of this for some reason at Vita sites where people have prizes and awards that they've received. And it could be a toaster oven. It could be they received a check because they entered some type of contest. Could be, I've seen game shows, things like that. So let's kind of use the game show example. So one time I was doing an audit for the IRS, and I had a taxpayer who received a 1099 MISC, and she'd gone on a game show and she'd won a TV and some other things to the tune of like maybe $8,000 or $9,000. And then she came in and she showed me basically an envelope filled with information where she'd gone out the same day that she had received her 1099 MISC, I think it was about 9,000. And she said, Jerry, I looked up all this stuff that was for sale in this particular area in Los Angeles. And even though the 1099 said 9,000, all that stuff was worth about 6,000. And that's what I reported on my return, the fair market value. And I said, okay. So I went through all of the documentation she had. I said, yeah, that's another way you can do it. If you want to report the 1099 amount on your return, you could do so. If you want to report the fair market value of all that stuff, and it has to be the same make and model and year and all that, you can do that also. And generally, the fair market value is going to be lower than the 1099 MISC. So I've explained that to people in the past, and I see that at the Vita site. And so I tell them, if you have the information, we can report the fair market value. Otherwise, we're going to use the 1099 that you receive from either the game show or whatever entity you won the money from or the prize from. Has anybody seen that at the Vita site? No? All right. Okay, next, jury pay. You see this from time to time. Most people, when they go on jury duty, they're paid. It's a modest fee. You're not going to get rich doing it. But what happens is you receive a document from the court after you've served on the jury, and they tell you this is the amount that you received in jury pay. You might also receive reimbursement for your travel. That's a different thing. That's reimbursement. That's not taxable. You're not going to report that. But you will report jury pay on your tax return. And then what happens is, like when I used to be a government worker, I'd have to come back with my jury paycheck, hand it to my secretary, and I didn't cash it. I don't know where it went, but I gave it to the secretary. That was a requirement because I was paid my full pay and allowances when I was an employee. So in that particular case, step number one, I reported it on my return. Step number two, I reported an adjustment to income on my return. And we'll show you this on the Tax Slayer program. So you might see that from time to time. But if someone, like for example, my wife went on jury duty a couple of years ago, she got a whopping check for like $80. And she goes, what should I do with it? I said, well, we'll report it on our return, but cash it and buy me something. But we're not going to do the report to the adjustment because she did not give it to her employer. She was self-employed at the time. So you may see that. Okay, so what I'll do now, I'll take a couple questions, then we'll take a quick break. Any questions about some of these selected income topics?
Hey, Jerry, on the fair market value of versus the 1099 miscellaneous, what is the acceptable paperwork that we can rely on to prepare taxes?
An example would be, let's say you've won, like one time I won a toaster oven at a bank. I was very excited. And so I got the toaster oven, and then you go, let's say you go on the website and you look up the same toaster oven, the same make, the same model, the same year, and then you hit print on your computer, and that toaster oven being sold at, let's say, Best Buy for $22, and my 1099 said $55. And so that's what I report, the fair market value. But it has to be, for lack of a better term, some type of evidence, some type of documentation where it's the same make, same model, it's the same item. And that's probably the best way to describe it. Now, if you win an automobile, then that's a big deal. Then you want to call the dealership and say, I got this automobile, here's the make, here's the model, here's the year, and here's all of the options on this particular vehicle. Can you tell me what I can buy this thing from you today? And then of getting that report or document from the car dealership, that would suffice for fair market value.
Okay, thank you.
Hey, Jerry, there's a question in the chat from Galaxy A71 about
Galaxy A71. Okay, let me check it out here.
Yeah, I private message that Galaxy to just speak up if she doesn't mind or he doesn't mind and change the name, but I haven't heard. So
Yeah, I'm attempting to open up the chat and I have been unsuccessful.
don't open up, Jerry, if that way you don't want to mess up your setting there.
Okay.
I just want to make sure that if he has a question, if anybody has a question that you want to really clarify, please do so. Unmute yourself and ask Jerry or the panel directly.
We can just
Yeah,
ask the question. You know, I have a question about my experience about credit card, and I'm a victim of a scam. What should I do?
What should you do if you're a victim of a credit card scam? Wow. That's one of those $64,000 questions. There might be tax consequence. I'll share this with you. Sometimes people come to me and say, hey, Jerry, I got this information return and I didn't have cancellation to debt. I didn't have income. I don't know what this entity is. What you can do, it takes a little bit of time, but you have that probably a discussion via mail with the IRS and say, IRS, this is not mine, because if you're called to audit, they're going to say, here's all these information returns that we received, and that's where you're going to say, I don't know what this company is, but you're going to have to have a discussion. But you know, there's also, in addition to tax consequences, if you've been scammed, also other consequences. So you probably want to get with someone to help you out. That's probably the best answer I give you as far as tax consequences. Anything else?
Yes, hello. My name is Francisco Prado with Pace Vita. I have a question regarding the using the fair market value as opposed to the miscellaneous. If we use the fair market value and it's like a major difference, like maybe like 60% of what was reported on the miscellaneous, would the IRS trigger a letter or a notice saying like, hey, you forgot to report this 1099 miscellaneous?
You know, it may very well, and then what may happen is you may go to what is called a correspondence audit, and then that's when you provide the information. Or sometimes you'll be asked to come in. Of course, now it's virtual, but when they start face to face again, then you might go to what is called a office audit, and the tax compliance officer would ask you to explain the difference. And I will tell you this: let's say go back to the car example. You want a car, and the car is 1099 is, let's say, 27,000, and the fair market value is 22,000. That's a $5,000 difference. And you know, for $1,000 in tax, federal tax, and then some additional state tax, it's well worth it to spend an hour in front of an IRS auditor or mailing off some documents to the IRS. A lot of people are afraid to go to the IRS, but if you're called in for an audit, you show up with your stuff, you have the option of hiring a representative, and you just you tell the IRS, this is my position. That's all.
Say, Jerry?
Yes.
To avoid triggering an audit, what do you think of reporting the miscellaneous income as reported on the 1099 miscellaneous, and then enter an adjustment to income and explain the difference there?
You know, I would not do that. Based on my training, based on my experience, I would report the fair market value if it differed from the 1099 MIS. That's what I would do.
Okay.
All right, we're about ready to take a break. I'll take one more question, then we'll take a 10-minute break.
Well, Jerry, I didn't hear. Would you be sending out any copies of these slides from last week and this week?
The ones from last week, I believe they were sent out, but yeah, just get with Fred or Steve or shoot me an email, and then we'll make sure you you get the PowerPoint.
Thank you.
Okay. All right, folks, let's take 10 minutes, and I'll see you then. All right, Steve, we're going to get started here.
All right, we're good.
All right, well, welcome back. Hopefully we have most, if not all, of our attendees back. So what we're going to do now, we're going to jump into the Schedule A as an alpha, and that's your itemized deductions. And the last time I looked, speaking for Vita, I don't know about AERP, about 10% might even be a little bit less, 9 or 10% of all the tax returns filed in the Vita program have a Schedule A. So you'll see Schedule A's, but you won't see them that often because that law that passed a couple of years ago, the Tax Cuts and Jobs Act of 2017, it essentially doubled the standard deduction. So what happened is a lot of people now, they take the standard deduction instead of the itemized deduction. And when you meet with taxpayers who don't have a lot of tax knowledge, what they'll do is they'll say, well, I've got all these deductions. I've got a dentist bill for $20, and I've got this and I've got that. And it's up to you. What I'll usually do is I'll say, well, I'll explain the concept of the standard deduction, and the general rule is you take the greater of. And then most people understand that. I'll even show them a Schedule A and say, these are the things that are on a Schedule A. But again, here's the standard deduction amount. And that will typically answer the question. But again, if you have people who want to itemize and their itemized deductions are going to be greater, then by all means, let's fill out the Schedule A. But let's talk about things that go on a Schedule A and things that you'll typically see. You have your medical and dental expenses at the very top. And if you're driving to the hospital, you drive yourself, you're visiting your spouse, your kids, someone who's on that tax return, those are called medical miles. And so you can deduct up to 17 cents per mile. And of course, that means going to the dentist, you name it. And then when you're talking about deductible expenses, the term is out-of-pocket medical. A lot of people, in fact, I knew one guy one time, he had a medical and dental plan from his work, and he paid nothing out of pocket. He paid nothing for doctors, nothing for dentists, nothing for eyeglasses, nothing for medicine. I don't know what type of plan that was, but I was quite jealous. But again, like the plan I have, it's a pretty good plan, but I still have to pay when I visit the doctor, $20, when I visit the dentist, $50, something like that. But that's what you're looking at, out-of-pocket medical expenses. And that also includes insurance premiums that you pay out of pocket. And examples on your screen include Medicare Part D, and that would be for your folks who are Social Security recipients. If I've had the discussion with a couple people, and I met yet another person yesterday, I always thought that it was a requirement that you had to enroll in Medicare. Well, apparently that's not the case. And someone correct me if I'm wrong, but I met two people now. They told me that they're not in Medicare, they're senior citizens, and they have no desire to be in Medicare. So apparently it's voluntary, but most people sign up because I guess the price is right. And then of course, what happens is there's a deduction right out of your Social Security check. But that's an example of an insurance premium. And then a lot of people get eyeglasses and hearing aids and crutches and things like that. And if you're paying out of pocket, that would also be medical expenses. And then you have nursing services. I had a client in my private practice who had a nurse that visited her and her husband because they're way in their late 80s. And that was a lot of money she was spending every month for a nurse to come in, a registered nurse to attend to them. And then this is something I've seen more and more, guide dogs, where you have people who have a mental or a physical disability, and then they have some type of, usually it's a dog, and the dogs obviously eat food, they have veterinarian bills, and so that's an example of out of pocket. And for non-deductible, there's a lot of things, and in your publication 4012, it has a laundry list of things that are not deductible. Teeth whitening is not deductible, maternity clothes are not deductible. Generally, cosmetic surgery is not deductible. And there's just a number of things that are not deductible. And so when people have medical expenses, you have to explain to them, and I'll show them the Schedule A, and I'll say you have to overcome what is called the Agi limitation. And the Agi limitation is the computer is going to calculate your adjusted gross income, and then all of your medical and dental expenses have to be above, for 2020, 10%. And so that's why a lot of people don't take medical and dental expenses. But if you have someone who's spending a lot of time at the doctor and dentist, and sometimes you'll have some of these taxpayers spending $20,000 or $30,000 out of pocket, and that will generate typically some type of tax deduction. And we could probably spend the rest of the morning talking about what's deductible and what's not. But typically, what you'll do is you'll go to your 4012. And you'll explain to the taxpayer, this is clearly a deductible item, this is clearly not. And if you're in that gray area, then you're going to have that discussion. So for example, cosmetic surgery, you might have someone who has cosmetic surgery and they say, I've got a court case, and I've had that before. So I'll read the court case and thinking, all right, yeah, your fact pattern is pretty much the same. So we'll put that on the tax return. But typically cosmetic surgery is not deductible. I think this is an important thing because we see this a lot, especially at sites that have seniors. Who wants to make a comment or some type of, or throw out some type of question on medical and dental expenses? What about one of our AERP volunteers? What are typically the expenses you see?
Well, don't forget about long-term care insurance.
Yeah, long-term care insurance. That's in your publication 4012, and that's those are premiums that you're paying. Yeah, that's another deductible one.
You see a lot of dental expenses because that's typically not covered by insurance plans. It's definitely not covered by Medicare.
Right. And so when you go, like I have dental insurance, I think it's like $300 a year. So that's an insurance premium that I pay. And then when I visit the dentist says, okay, Jerry, it's $50 to get your teeth cleaned. I don't know if that's a good deal or not, but I pay it. And then if they want to do the deep cleaning, they say it's $80. And again, I don't know if that's good or bad, but I write the check and they do their thing. And that's a medical expense. But again, I have to overcome that AGI limitation. And
even though, this is Julie, and even though we work primarily, the people we see are primarily retired senior citizens who would typically have a lot of medical bills, I have seen very few that actually exceed the minimum.
The AGI limitation, yeah.
Right, because most people are on Medicare, and so they mostly never quite exceed that. At least I haven't seen very many. Yes, once in a while there will be someone because of extreme expenses, but in general, I haven't seen that many that actually exceed the.
Yeah, and that's a good point. That's what I typically see at the sites. I've seen people who are on Social Security, they have modest income, and they have $20,000 or $30,000 worth of out-of-pocket expenses. And you're right, that's typically those situations where they have a lot of expenses, they've had a tough year. But again, that's something that spelled out in painstaking detail in your publication 4012. You can also look in your publication 17. It has a laundry list of what is and what is not deductible. All right, let's move on to the next one, state and local taxes. This is something that
we also get a lot of people have the deductible part of their assisted living because part of it is medical expenses. And we get a letter from the company that says they paid $60,000, $35,000 is medical.
Yeah, that's a good point. I had a client who I think she spent like $55,000 and we went through it. And you're right, a lot of that was essentially medical assistance. And that's something she took on her tax return, yeah.
How about access for handicap? Converting a normal access by non-disabled person to a disabled person. Is that deductible?
You know, I seem to remember something, I probably don't have it off the top of my brain, but when you change your front porch, when you change something in your house, someone who needs access, I know there's some type of deduction associated with that, but it's not, I don't have it on the top of my head.
So that would also be for bathroom conversions, let's say.
Yeah, and who's asking that question?
Raul Fernandez.
So what I'll do, Raul, unless somebody knows the answer right now, I'll look it up and then I'll have that answer. If not by the end of the day, then next week we'll talk about improvements to a home.
Okay, just wondering. Thank you.
Okay, moving on. State and local taxes. In the state of California, when you file a tax return and you're a resident of California, The only jurisdiction that I'm aware of in California that has an income tax is the state of California. Of course, we know the feds do, but San Francisco, a beautiful city. My wife and I go up there a lot. Even San Francisco, which is a beautiful city that they love taxes up there, they do not have an income tax. And so when you're talking about local taxes, there's no such thing as local taxes on a Vita return in the state of California. Now, there are other jurisdictions that have an income tax. The city of New York has an income tax. I believe Lansing, Michigan has an income tax. The District of Columbia, they've got an income tax, but you're typically not going to see that because we're working with California residents. So again,
counties in Ohio.
What's that?
Certain counties in Ohio also.
Yeah. So you're going to see that. And if you stay in the tax world for 20 or 30 years, you're going to see stuff every day, and you're going to scratch your head and say, "What's this?" Because there's just a lot of stuff. Okay, so for state tax withheld, that will come from paycheck, a W-2, and typically your wage earners will have tax withheld. And that also, of course, will also have federal income tax withheld, but we don't have federal income taxes on a Schedule A, just that state tax withheld. And then your state tax payments, that could be someone who is a self-employed individual. I remember one time I was calculating my state tax and thought, hey, you know something? I have insufficient withholding, so I made an estimated tax payment to the state of California. So all of that stuff then goes on the Schedule A as an alpha. And then, of course, you do know that Tax Cuts and Jobs Act from a couple of years ago, it limited, there was a big discussion about the so-called SALT deduction, state and local income tax deduction. Well, the maximum is $10,000. And so you may enter a bunch of stuff in the Schedule A, and the taxers say, hey, what happened to the other 5,000 or 6,000? And you simply tell them that's not something that you can deduct anymore under current tax law. But the computer will do it for you automatically. And then if you have a situation where someone says, you know, I don't want to take that state tax withheld deduction, I want to take the state and local tax paid, sales tax paid, then when you get into the software, and we're going to show you this, you'll hit a tab, and then you will enter the sales tax that they paid. So that means the sales tax on certain food products, the sales tax that they paid to when they went out to a restaurant. Maybe they purchased a large ticket item like an automobile or a recreational vehicle, something like that. But again, the limit is still $10,000 on a federal tax return. So you get either or. And I have seen that a couple times at the Vita site. I don't know what your experience has been, but I've seen it a couple times at state and local sales paid. But again, it's either or. Who's seen that state and local sales tax paid?
Hi, it's Julie. Just to let you know, back before they changed the standard deduction to 13,000 something, I used to actually take the state tax paid because I was no longer employed, so I didn't pay any state income tax. And I just kept all my receipts, and there's also a tool where you can figure it out, what they kind of estimate, like what your income is, what your state tax paid was. So it was beneficial before they changed the standard deduction, but it's no longer beneficial because I don't have that much.
It's no longer beneficial for you?
For me, you know, you would have to have a very high income for you to have paid enough state, local, sales taxes to actually be beneficial at this point.
Okay, gotcha. And then
there is a tool. You can go on the IRS website and you can put in a bunch of information, how many people live in the household, what the AGI is, what county you live in, blah, 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 and it'll spit out a number. And sometimes we use that when people are itemizing because maybe they don't pay income tax, state income tax because they're retired, but they pay sales tax, and that can boost it up to enough maybe for them to itemize. But for me personally, it doesn't anymore.
Yeah, that's a good point. And then also, I recognize some people on the call may not be regular shoppers. I'm not a regular shopper. Thankfully, my wife does most of the shopping. But when I shop, I'll occasionally look at the receipt. And when you go to the grocery store, there are some items that are taxed and there are other items that are not. So if you bought a gallon of milk, there's no sales tax on that gallon of milk. If you buy a pack of cigarettes or a bottle of whiskey, you're going to pay sales tax. And so that's how that works. Okay. Next, real property tax. A lot of our folks, they've owned their house and they pay property tax. And so typically that's going to be right from the tax bill. A lot of people, they've got copies of checks, or maybe they access the county assessor and they can get their property tax bill. And in your publication 4012, it does a pretty good job talking about property tax. And then personal property tax, probably the best example I can think of, you're going to have your vehicle, and on your DMV bill, it'll say the amount that you can deduct or should be able to deduct on your Schedule A. Other personal property tax, perhaps maybe you have some type of water vessel, i.e. a personal water vessel, whatever they're called. I believe you have to pay personal property tax on that to the county. But again, that would be somebody to come in with all their bills. What's another example of personal property tax that you've seen?
It's been a while, but I've seen mobile homes.
You've seen what?
I said it's been a while, but I've seen it personal property tax on mobile homes.
Oh, mobile homes. Yeah, I think if you have a mobile home, there's different types. I think you have to pay a personal property tax. And then again, DMV bills, and then your assessor statements for that. Okay, home mortgage interest. This is a big one. A lot of people, they borrow money. They typically borrow money from a bank. If you don't borrow money from a bank, then you can still take a deduction. You're simply going to have to get some type of, typically you get the promissory note, maybe an amortization schedule. But most people will come in with a Form 1098, and that'll be from their mortgage company. And it's important, if they've sold their loan, if they've refied, then they may have two 1098s. And so you'll simply ask them, tell me about your home loan and how many of these do you have? And then that way you're going to add up the interest that the bank has received and the taxpayer has paid. And typically on the 1098, you'll have interest received by the bank, any mortgage insurance premiums received by the bank, and any points received by the bank. So we'll talk a little bit about, interest is pretty basic. Again, you're going to get the 1098. That's pretty basic. It'll be stated there. Mortgage interest premiums, and I'm not a mortgage guy. I've had a bunch of mortgages, but I've never sold mortgages. I have not been a banker for many years. But mortgage insurance premiums, that's when you were told by the bank, hey, if you want a loan, you're going to have to pay some type of mortgage insurance. And if you want the loan, you pay the mortgage insurance. Perhaps maybe your loan to value is not what it should be. But the bottom line is that's something that's reported on the 1098. And then, of course, for the purposes of the tax return, the Schedule A, that private mortgage insurance is a deductible item. And then points, most of us who have purchased a home, we have probably paid points. And when you talk about points, you have an option. You can deduct those points in full when you pay them. If you don't want to do that, then you have another option. You can amortize those points, which means, and I have an example there. Let's say in the year that you purchase your private residence, you pay $3,000 in points. And points are basically, it's a fee. When you get a loan, there's all sorts of fees, and one fee is points, which means it's typically a percentage of the loan. So let's say in this example, this individual got a loan for $300,000, and there is only 1 point. So that'd be that $3,000. And then they decide they want to amortize. So the loan is 30 years, let's say. And so you take 3,000 divided by 30, you get $100 per year. What's that?
It's $100 a year then.
Correct, as stated on the PowerPoint. And of course, I will tell you from personal experience, I had a home loan one time that was 1 year. I had a home loan that was 20 years. I've had home loans that are 30 years. So home loans are like people. Whatever you agree with the bank and it doesn't violate any federal or state law, again, you can get a loan for 6 years, 10 years, 12 years. It depends on what you work at. But most home loans are 30 years, most of them. But again, there's an example, amortize. So you can't do both. You either deduct your points that you paid or you choose to amortize. And so you're saying, Jerry, why are we talking about this? Well, let's say you have someone who has purchased a residence and they don't have enough deductions on their Schedule A. Then what happens is that they bought the house in 2020, and in 2021, they cannot take a deduction for the points that they paid in 2020. But what they can do, they can continue to amortize over that 30-year loan. And so they get some type, I grant you, it's a modest tax benefit, but nonetheless, they're not going to lose it if they amortize. And then another example, when you refi your loan, unless you use it for remodeling your residence, you're going to have to amortize your points that you paid for the refi. Has anybody ever seen amortization of points on a Schedule A? No? Okay. And the private mortgage insurance, I think I paid that on one of my loans years ago, and that's something that's explained in on page F9 in your publication 4012. That's something that you can deduct.
Hey, Jerry, I have some folks raising their hands on.
Okay.
Margaret, did you raise your hands? Can you ask your question? Unmute yourself. And then there's also one that says owner. So I'm not sure who this is, but.
No, that was from earlier when you asked us to raise our hands if we were new. Sorry.
Okay, no problem. Somebody else raised a hand, and it's the tag on the Zoom is called owner. So if that's you, go ahead and ask the question.
I did have a comment more than a question, Jerry. I believe that on a purchase loan, when you're buying a house, in other words, you can go ahead and take the full expense of the points on the year that you take the loan. But if it's a refinance, you have to amortize it. I don't think it's up to you to decide.
Correct, and that's shown on the screen that you're looking at under points. Correct, you're correct. Okay, all right, and then again, we'll show you in the software here some of these things. So let's go on to the next item that you see on a Schedule A, and this is something that a lot of people who come to the Vita site who itemize, they're going to have some type of charitable deductions. And so you want to make sure it's what is called a qualified charitable organization. And there are probably tens of thousands of them in the United States. And so when someone calls me up, I've got clients who call me up and say, Jerry, can I deduct this as a charitable contribution? And I always ask them, well, what's the name of the organization? And do they have some type of employer identification number or a tax ID number? Because what happens is, to become qualified, you have to fill out a bunch of forms. You got to tell the IRS, we want to be qualified under some particular code section. And then what happens is an examiner or a revenue agent will look at the application and then make a determination if this organization is qualified. And then qualified charitable organizations, they have to file a tax return. It's called the Form 990, and that 990 is a matter of public record. And so again, most qualified charitable organizations, they're going to give you a tax ID exempt number. They're going to give you the full name of the organization. They're going to be upfront because what they want is they want to obviously generate revenues so they can benefit society at large. So let me do this. There's a tool, and hopefully you've seen this before. It's called the TEOS, which is the tax exempt organization. So let's look it up right from the IRS website. And hopefully you can see it. Steve, can you see where it says tax exempt organization?
I only see your PowerPoint.
Bummer. Okay, so what we're going to do here is I'm going to go ahead and stop sharing and see if I can go to the. Hold on just a moment. Let me see if I can open up the IRS site that we're looking at. And while I'm opening this up, let me ask the audience out there, typically what type of charitable deductions are you seeing at your Vita site or AERP site?
Donation to
We
church.
see church contributions.
Yeah.
Okay. And of course, St. Killian's is, the last time I checked, they were a qualified charitable organization. And you want to be careful about that because there are many different types of houses of worship. And to my knowledge, you can wake up tomorrow, you can self-anoint yourself as a pastor, and you can bring people into your house and you can proselytize to those individuals. There's no federal or state law against that. There might be a COVID thing about that, but in regular times, you can bring people in your house and you can proselytize all you want, and you can collect money from them. If you do that and you're not a qualified charitable organization, then you have what is called self-employment income. So again, you want to make sure that church or house of worship is qualified. Steve, can you see the tax exempt organization site now?
Yes, sir.
All right. So this is your site, and I share this story because it was very helpful to this taxpayer. Taxpayer a couple years ago donated about $8,000 to an organization in Orange County. Can't remember the name anymore. And we were looking at it. It was 2 CPAs and myself. We were looking at this, and I just kind of shook my head and said, you know, this doesn't make sense. So we did the search for this taxpayer, and we had to break the news to her that it was not a qualified charitable organization. It was some entity that helped people out, but they were not tax exempt. And we said, this is not a deductible item. And then she said, okay, I got it. And then she decided to spend her money with other organizations that were tax exempt. But this is what you want to do. Again, the URL is your IRS TEOS, which stands for Tax Exempt Organization Search. And then you can see there's data down here. Way back in the day when there was a hard copy document, it used to be called Publication 78. We call it the Big Blue Book. It was a multi-page, probably a couple thousand pages of all the charitable organizations. All of this stuff is online. You can dig right down to it. You can also look at that particular charitable organization's Form 990. And so again, you want to use this website if you are in doubt, or if the taxpayer is in doubt whether or not the organization is tax exempt.
May I explain one situation that I had where a taxpayer made a quote taxable deduction to a charitable organization? However, it turned out that the charitable organization then turned around and made a loan to a relative of hers. So that then disqualified her taxable charitable distribution because she received a benefit from that charity.
The taxpayer received a benefit, or the taxpayer's sister?
Well, the taxpayer, it was
related.
that the taxpayer received the benefit because the only reason they made the loan to her family member was because she made the donation to that. It was some convoluted thing. But the reality is, if you make a charitable distribution, but you get something back from it, it's no longer valid, or some portion of it back. And in her particular case, because somebody in her family got benefit, it counted as it counted basically against her, and she wasn't allowed to use it.
Very interesting. You'll probably never see that at a Vita site, but very
right.
This is let's check out that charity too.
This is Donna. I wonder whether this is this type of kind of a fraud, money laundering, right? Yeah. You get a tax deduction.
Yeah.
They may even lose their 501c status. You know, this is a big deal. It's a very big deal, I think.
Well, I believe that the organization is a legitimate charitable organization. However, because of the way some of what they did.
Yeah, is that part of their?
They weren't trying to defraud anybody. She just didn't understand.
No, the point is they took a deduction for it. You know.
No, she wasn't allowed to take the deduction. But it's
she
did
because you caught it. Because you caught it.
Right.
Well, that's a whole can of worm.
Yeah. Very interesting. Like I
that
say,
is a whole can of worm, because
you will probably never see that at a Vita site. But if you have a bizarre situation, you can bounce it to a tax professional. You can call the IRS, but I've never seen that. But again, Good topic. All right, here we're going to move on. Charitable deductions. We talked about the site. That particular site again is www.irs.gov. I guess that's a /TEOS. Now the new tax law, we talked about this. If you're donating money to a charitable organization in 2020, you can take up to 100% of your AGI. I don't think you're going to see that because most people need money to live. But again, that's the rule for 2020. And then let's talk about charitable work. There's a lot of people that. What's that? There's a lot of people that do charitable work. And when you're doing charitable work, you're driving for the charity. Typically, you're not going to be compensated. So you're driving around, you're dropping things off, you're meeting people, you're engaged in some type of work, again, for the charity. You can take 14 cents a mile. And then if you also incur parking and tolls for the charity, then that's something you can deduct in addition to that 14 cents a mile. And so like, for example, I did some charity work a couple of years ago. I'm driving places, I'm meeting with people, we're doing things on behalf of the charitable organization. And then that would be the deduction I can take, 14 cents a mile. Miscellaneous deductions, that used to be a big thing a couple of years ago with a new tax law. Most of your miscellaneous deductions are gone. The ones that you probably see at the Vita site, gambling losses. For some strange reason, at the site that I work at, we have a lot of gamblers. And so what that means is they'll come in and say, Jerry, I had some gambling losses. I explained the rules. You can take your losses on a Schedule A if you itemize up to your winnings. So you're going to report your winnings, you're going to report your losses. And then this is something that I really didn't know. I knew a lot about professional gamblers. I didn't know a lot about non-professional gamblers. Non-professional gamblers are recreational gamblers. Guys like me, I go to Vegas maybe once a year. I'll go to a table. I don't know what I'm doing. I'll give the money to the casino. I'm a non-professional gambler. But if I want to take my losses, again, up to the winnings, I have to keep adequate records. And the IRS says you've got to jot down where you were, what casino, who you were with, what games you were playing. So you got to take some notes. So if you ever went to an examination from the IRS, that auditor, if they're doing their job correctly, they're going to ask you a whole bunch of questions as a non-professional gambler. Where were you? What did you play? Who were you with? And how much did you lose? And that's a requirement. That's a requirement. Now, of course, if you're a professional gambler, you also have to keep records, but this is for recreational gamblers. Does anybody see a lot of gambling at their site?
Yeah, hi, Jerry, this is Sean. And at St. Killian last year, I did encounter several people, including one who had more than 10,000 in winnings, but he also had more than 15,000 in losses. So,
okay.
And as far as the records, if somebody goes to casinos all the time and they get those club cards, in the event they did win, the club card, if you're using it all the time, keeps track of all your losses too.
Oh, that is true. I had a club card one time, and I was going to the tables and also the slot machines. And you're right, it's a very good record. But again, just keep in mind.
This is Jana, and a similar note, there was a 1099 fraud from the casinos. They were showing withholding, giving 1099s, and people are getting refund without the actual income there. So IRS had as a project like 2 years ago, catching those 1099, and I'm just letting you know, be careful when you see a withholding tax on a 1099 on the gambling. Make sure it's genuine somehow. Yeah.
Yeah, and I got to say, that's a good point. As a former IRS revenue agent, when I talk to my clients or the Vita clients, I like to ask a lot of questions, because when you ask questions and people give you the correct answer, usually what happens then, you have a full understanding of what's going on. So even though somebody has some type of information return, I'm still going to ask them a whole bunch of questions, and sometimes they get irritated with me. But the reason I do is because you never know. There could be a mistake, or maybe there's additional information that you're going to be able to obtain. Okay, a couple other things that you might see on a Vita return. Claim of right. Claim of right can get real complicated. We're going to talk about the very basics. What that means is, let's say in tax year 2019, you were paid $15,000. And then in tax year 2020, you were told by the person or the entity that paid you, hey, you got to pay some of this money back for whatever reason. So you pay it back in 2020. Well, what that means is you reported all that income in 2019. you paid some of it back in 2020, that's called a claim of right. So you can take a deduction on your Schedule A. And I've seen that a couple times, both in my IRS work and also with my clients. So you might see that. And then impairment related work expenses. This could be someone who has some type of mental or physical disability, and they are pulling money out of their own pocket so they can go ahead and work in some capacity or maybe work at a higher level. And that's something that also is a miscellaneous deduction, not subject to the 2%. All that 2% stuff that we knew about years ago, a 2% AGI, that has been suspended. And if the law doesn't change, then it will be resurrected in tax year 2026. So those are your miscellaneous deductions. All right, anything else before we jump into our next slide? All right, here we go. As soon as I reestablish myself here. Okay, let's talk about the Schedule C. And for a lot of us, you don't see a lot of Schedule Cs, but when you do see a Schedule C, it's pretty basic. If you have any type of training in accounting, a Schedule C is basically an income statement. And it's pretty basic. You're going to report income, you're going to report your expenses that are allowed, and then the difference is going to be what is called net income or net losses. And in the Vita program, we don't deal with net losses, we deal with net income. So let's talk about the Schedule C. The Schedule C is for sole proprietors. And in the very top of the screen, it talks about Internal Revenue Code Section 61. We're not trying to turn you into a revenue agent, but what that code section talks about is pretty basic. It basically says you're going to report all of your income that you received on your return that you receive unless it's excluded somewhere. Now, there's lots of exclusions, like, for example, what's an example? Well, an example, here we go. Let's say you receive a disability check each month from the Veterans Administration. You were injured in combat, something like that. That's an example of something that's excluded from income. And there are many different examples. And so when I usually ask people, hey, how much did you earn in your work as a self-employed individual? A lot of times they'll kind of look up in the ceiling and say, I don't know. I'm thinking, okay, let's go ahead and kind of deconstruct what you did. Tell me about the activity that you're involved in, your self-employment. And you might have multiple types of revenue streams. You might be a garage mechanic, and then maybe you sell flowers, and then maybe you have an Uber, and drive an Uber. And so you want to ask the person what they do. If they're involved in different activities, you have different Schedule Cs. But for this example, we're going to look at one activity, one self-employment activity, and we're dealing with people who receive some type of income, and that typically would be currency. It might be coins. It might be some direct deposit to their bank account, or it might be some type of check, a negotiable instrument. All of that stuff is income. And if you're a cash method taxpayer, what you're doing, you're going to report your income in the accounting period or the year that you received it. And so a lot of times, like I think I gave you this example a couple of weeks ago. I received a check one time from a client, and it was a small check, and I set it on my desk and I forgot about it. I got it in tax year 2019. I finally cashed it in tax year 2020. Because I'm a cash method taxpayer, I report that income when I received it, and I received that income in 2019. And you might see that from time to time. Here's another thing. When you're self-employed, you have to have some type of methodology or accounting where you're accounting for the monies or the cash or the income or the gross receipts that you receive. And a lot of people might have QuickBooks, or maybe they got a scratchy piece of paper. This involves an interview, because again, for some self-employed individual, they don't have QuickBooks. They might have some other method where it might be a scratchy piece of paper. But ask some questions about that. And if you know anything about the IRS, and I know we have an IRS agent here, they're taught about indirect income methodologies to determine how much income you received in a year. And so you want to be candid. The taxpayer wants to be candid. If the taxpayer is not candid, I always tell them, I don't feel comfortable doing your return because what you're telling me does not make sense based on my training and education. up to you, up to the site coordinator. At my site, when I see that, I tell the taxpayer as a site coordinator, we're not going to help you out here because based on what you tell me, it defies logic. So you're going to have to go somewhere else. Now, I'll put it in Care Bear language, but again, I'm not going to help someone who's, for lack of a better term, playing games. So on the gross receipts, a couple other things. We don't do cost of goods sold, which means if someone's buying a bunch of merchandise and they're marking it up, we don't do that stuff. We don't do inventory. And if they have that, they'll typically say, well, what do I do, Jerry? I say, well, we're not going to help you here. You're going to have to go out in town and find yourself a tax professional. I don't know, look in the phone book, look online. We can't help you. Non-negotiable, don't do it. And then other income, let's say you have someone who is, for example, let's say they have a very small deli, and then maybe they have other income, and that other income could be a small parking lot next to their small deli. That might be an example of other income. But again, you want to ask the questions. And again, when I talk to someone who's self-employed, I ask a whole bunch of questions about the income they received in a particular accounting period. And then we try to get it down to that last dollar. And sometimes it involves looking at bank account statements. But keep in mind, self-employed people don't take all of their money and put it directly into a bank account. It's been my experience, they'll take that money, especially if it's cash, they'll stick in their pocket and they'll spend it. And a lot of times it doesn't end up on their Schedule C. But again, you're gonna learn about that. There's a big discussion. The publication 334 talks about it in the publication 4012. You want to spend time. Like I used to tell people when I used to train tax auditors, I would tell them, yeah, you're going to worry about deductions and credits and all that, but spend time on income because that's where people, for whatever reasons, they don't report it or they don't report all of it. Material participation, this is one of the questions in your tax Slayer program. You're not going to spend a lot of time on it because it boils down to this. Did they run the business? Did they do the work? If you are a tax person and you want to dig into it, then go to the temporary regulation 1.469-5T, and that gives you all the rules of material participation. You got to meet one of them. There's a number of them. But again, I always ask people, hey, are you involved in the business day to day? The answer is yes. I'm driving the Uber car. Yes, I'm selling the donuts. Yes, I'm the locksmith and I'm fixing the locks. And that would be material participation. If they do not materially participate, that means we don't help them in the Vita program. And then qualified joint venture, I looked into publication 4012, correct me if I'm wrong, I think that's within scope. So for example, me and my wife and I, we have a tax practice. And what we do is we help out clients, of course we charge them. And then what happens at the end of the year, we are not a partnership, we're a qualified joint venture. So in the software, we indicate that 2 Schedule Cs are generated, splitting the income, splitting the deductions, and then we both have net income, and then we both pay self-employment tax. And that would be for a married couple, not 2 partners. They have to be a married couple for a qualified joint venture. And then deductions. We spend a lot of times talking about deductions, and it really boils down to this. And this is what I tell people, whether they're Vita clients or clients of my business, I tell them, if you're engaged in a trade or a business and you have expenses that are ordinary and necessary, there's a business purpose and they're reasonable, then it's deductible. And then some people will say, well, Jerry, what's reasonable to you might not be reasonable to me. Well, that's when you have the discussion. And I guess the best example I can think of, I audited a real estate agent one time, and she would make these sales and she would have a very small commission. It may have been like maybe $400 or $500, very small commission. And then she would have a feast with her client. They would go out and they would spend hundreds and hundreds and hundreds of dollars. And I said, this is not reasonable. I don't know what is, maybe 25, maybe 50, but if you have a real estate commission of $400 and you're spending $500 to celebrate, that is not reasonable. And that deduction would not be allowed. And I think our revenue agent wouldn't allow that either. I certainly didn't. But again, those are the things that you want to do for a deduction. And then here's another thing. Everybody has a cell phone, even 3-year-old kids. And so, for example, I've got one cell phone. I use it for my real estate business, my tax business. I use it for my college teaching. And then I use it for, family and friends. I cannot deduct my cell phone on my Schedule C. I can't do it. If I had a business cell phone, then I would be able to deduct it. Same thing with internet. I have one internet service that I use for everything. I cannot deduct that, even though I use some of it for business. So if you have someone with a cell phone and there's no additional business charges, or someone with internet service and there's no additional business charges, that is a non-deductible item, period. You're going to see that a lot. You're going to see that a lot. And then other things with the Schedule C, no employees, no depreciation. Sometimes you're going to have someone who wants to do depreciation. I don't know what you do in AERP, but in the Vita program, stay away from depreciation. Depreciation can get super complicated super fast, but we don't do depreciation. For the military module, you will do depreciation, but the taxpayer has to bring in the dollar amount. That's how you do it in the military module. But stay away from depreciation because it can get real complicated real fast. Okay, so what I'm going to do now, it's almost 11. Let's open it up for questions, and then we'll take our next break.
Hey, Jerry, we are getting a lot of Uber drivers in our site, right? And it is essential that they have their smartphone with them. They are using that for them to call rides and to navigate. But they're also using that for personal. But that is essential. Without the phone, there's no income. Are you telling me right now that it is non-deductible?
That is correct. It is not deductible. If that person has one phone in their whole life, that's the only phone they have. Like, for example, I have one phone. I used to have 3 phones, and I think, why do I need 3 phones? So I have one phone, not deductible. Now, there might be a plan where you have a bit, like you call over to Europe or you call over to Africa, you got clients in Africa or South America, and maybe there's an additional charge. That would be a business charge. But that basic cell phone, your monthly, I don't know what people pay. I think I pay like $30 a month. You cannot deduct it if you have one phone. Now, if I purchased a phone program and I got a phone and I use it for my tax business, 100% deductible.
So right now, if I ask this Uber driver, if you're not an Uber driver, are you going to have a phone? If the answer there is, I'm not going to have a phone if I'm not an Uber driver, so I'm going to accept the phone as a deduction, even if it's under his name and he has some occasional personal calls.
This is the question you want to ask. You want to ask the taxpayer, how many telephones do you have in your life? And most taxpayers are going to say, I have one. You say, okay, great. That is not a deductible item. Now, if they say I've got 2 phones and I use one for business and one for everything else, okay, fine. Then that business phone, that's a fully deductible item.
And that's non-negotiable.
What's that?
It's non-negotiable. That's it.
It's non-negotiable. Now, it's not a big item, but I will tell you from personal experience, if you get, now I'm not trying to scare anybody, but I mean, life happens. If you go in front of a tax compliance officer, what they're going to do, they're going to spend a bunch of time with income. They're going to bounce down to deductions, and then they have what is called low-hanging fruit. Cell phone is low-hanging fruit. Meals and entertainment, low-hanging fruit. And then before you know it, you've got all these disallowances, and then the tax auditor says, hey, before you leave, let's open up the previous year, and now you've got all of this additional tax, and penalties, and interest. You just want to stay away from it. It's just it's just unpleasant. I had a client that I helped out recently, and this guy, he ended up owing $9,000 because he took all this crazy stuff on his Schedule C, and now he's got to pay off $9,000 in tax, penalties, and interest.
Okay, just so I do that all the time, all day last year, but I guess that's a mistake.
Like Nancy Reagan said many years ago, just say no.
I have a follow-up question in regards to that. Let's say if you have a real estate agent or a sole proprietorship for Schedule C, and he have a home office, he prorates his home office by square footage, and he uses that too for all the utilities and other services that he uses it for the business. And that's allowable, is it not?
You talking about the home office?
Home office, yeah.
Yeah, what I remember, and I think I looked this up the other day, I think in the Vita program, I don't think we work with the taxpayers who have a home office, but if you're advising people then yeah, if they have a home office they're using regularly and exclusively for some type of trade or business, then they can take a deduction. There are certain limitations. And yes, what they can do, there's a different method, the square foot method. And as far as expenses, i.e. utilities and things like that, yeah, that can go on that form. But again, I don't think we do that in the Vita program, the business use of the office, or business use of the home.
Yeah, because of this COVID, this pandemic, everybody's working from home now. So
yeah, I will grant you that, but I have not seen any changes in the Internal Revenue Code or the Treasury regulations or a revenue ruling. I haven't until I see that. If someone says, "Hey, we're going to do business use of the home in Vita," my answer would be no.
Okay, gotcha. Thank you.
All right, sure. Okay, hey folks, we're going to take 10 minutes. Let's come back at 11:11.
Go ahead, Jerry, if you are ready.
Okay, we're gonna get started. I think it's 11:11. Okay, so let's finish up our discussion with the Schedule C. And we know that if you are engaged in some type of trade or business and you're using your vehicle, then of course you're going to be able to get that that deduction for the business use. In the Vita program, we use the standard mileage rate, and there's also the actual expense method. So the actual expense method, if someone is bound and determined to use that method, then they're going to have to go to a paid practitioner, because we don't do that in Vita. So for this year, it's 57.5 cents a mile. It's calculated automatically in the software. Of course, the software is going to ask you when you placed your vehicle into service, the type of vehicle you have. And then the software is also going to ask you your business miles. It's going to ask you about your community miles, and it's going to ask you about your other miles. And so if you are self-employed, then you're probably not going to have any commuting miles. Commuting miles are defined as going from your house to your place of work and from your place of work back to your house. That's basically it. That's non-deductible, whether you're 3 miles from your work or 300 miles. I used to commute to Sacramento from Orange County, and that was a non-deductible expense because that's commuting. Okay, and another thing, if you haven't looked at the publication 463, the IRS Pub 463, it does a really good job talking about car expenses, vehicle expenses, and so I would encourage you to jump into that before the Vita season kicks off. So here's other things you can deduct in addition to the standard mileage rate. The business portion of interest that you're paying on your vehicle. And so if you're using your vehicle, let's say 20 or 30% of the time, then you would you'd take that that allocation for the interest if you have a vehicle loan and you're paying on that loan. Also, everybody pays some type of DMV fee for their vehicle. And so if you've got that one vehicle, then you can take a business portion. Of course, you simply allocate. So the example is, let's say your DMV fee that you typically deduct on your Schedule A as an alpha is $100. And you use your vehicle in your business 30% of the time. So that you could deduct $30 on your Schedule C, $70 on your Schedule A, again, under the standard mileage rate. And then also business parking and tolls. Around here, I don't know the name of the toll roads, but every once in a while I'll jump on them and there's a charge. So if you're going to visit your clients, or if you're an Uber driver, and in this example, let's say the Uber driver is self-employed, which I think they are, and they're incurring tolls and they're paying out of pocket, then that's another example of something that can go on the Schedule C as in Charlie. And then a lot of people, you can read about the Schedule CEZ and the Schedule C. You're going to enter the data into the software, and the software is going to kick out either form. So we're not going to be too concerned about that. Estimated tax payments. This is something that I talk to people all the time. If you're self-employed, it really behooves you to make estimated tax payments, because if you don't, at the end of the year, for lack of a better term, you're going to get clobbered. You're going to pay a lot of tax. You're going to pay penalties. It's just a very unpleasant thing. And then what that means is you're behind the 8 ball. And so I educate people as best I can. I tell them, look, it's painful when you get that big check. You want to go out and spend it. But what you want to do, you want to take some of that money and make an estimated tax payment. And the first thing, you got to estimate the income you're going to have for the year. And that's both for the federal and the state government. And once you do that, then you get into that habit, and that way you avoid difficulties with the IRS and the Franchise Tax Board. But new self-employed individuals, a lot of them get themselves into trouble with not making estimated tax payments. And again, that's also described in the publication 334. And then the qualified business income deduction, that's new for the last couple years. And for our self-employed individuals, the vast majority of them, they're going to be able to take that deduction. It's done pretty much automatically, 20% of net income. And again, that's a great deduction, and hopefully that'll be around for our self-employed folks for a while. Okay, we're gonna kind of pick up the pace so I can show you some tax slayer stuff. So when you talk about the Schedule D, the bottom line is when someone says, I've got a capital asset, typically a capital asset is going to be stocks and bonds. That's typically what you're going to see. But a capital asset could also be a personal residence or a personal vehicle. And if you have someone who sells their home, then typically you're probably going to see some type of gain. But again, a personal residence is a capital asset. And then we don't deal with accounts receivable, we don't deal with inventory, but we do deal with people who are engaged in a trade or a business. And if they're using an asset in a trade or a business, that's not going to be a capital asset. They're going to have to use what is called the Form 4797 when they sell that item. And so for taxpayers like that, you'll say, sorry, can't help you. But you can explain things to them. But like I said before, if you open the door, you're probably go to something that's out of scope. You're going to make the site coordinator unhappy. And then that taxpayer, they're going to go and tell all their friends. And then you're going to have people coming down to your site. Just don't do it. If it's out of scope, it's out of scope. If you go to your publication 4012, those first few pages talks about what's in scope and out of scope. And I'll be the first to admit if someone says, Jerry, is this in scope or out of scope? A lot of times I say, I don't know. I got to look it up. I don't have this stuff memorized. And that's okay. That's why you got the 4012. When you talk about the disposition of a capital asset, basically you're talking about you're relinquishing title, which means you're selling that particular asset. That's typically what it is. And you're not concerned about calculating short-term or long-term gains or losses. It's done automatically in your software. But what's really important, I saw this a couple years ago at a site. I was sitting there and I was racking my brain, and I had a CPA who's pretty sharp sitting next to me, and we couldn't figure out why this taxpayer had such a small tax that they owed on their tax return. And all of a sudden the light bulb went off. This guy, all he had was long-term capital gain and a little bit of income. So he owed virtually nothing. So you're going to see that, and sometimes taxpayers will become confused. So all you got to tell them is, here's this particular worksheet. You can also tell them long-term gains are taxed at preferential rates, and these long-term gains rates in some cases are very low compared to ordinary rates. And so again, just an explanation. Obviously, people are happy not paying a lot of tax, but you'll see that from time to time. And then this is not a college tax class. We're not in law school, but you're going to get people talking about basis or adjusted basis all the time. When you hear that term, it simply means you buy something, you got cost or basis. That's basically the same thing. And when you add something to it, then you have what is called adjusted basis. And when you're selling a personal residence, you definitely want to know what you're doing if you're going to help the taxpayer, because you want to ensure that you calculate adjusted basis, which means, we'll get into it in just a little bit, you've got to look at all of the items that were added to that particular house. In this example, we've got a motorcycle. So you got a guy or a gal who buys a motorcycle for $20K. They put on those fancy chrome pipes. I think they're called chrome pipes for $5,000. The adjusted basis of that motorcycle is $25,000. If this is a personal asset or a personal vehicle, that means that they sold it for $30,000, they would have a gain of $5,000, and they'd report that gain on their tax return. If they sold it for $20,000, they would have a loss of $5,000, and they would not report it. And then some people say, Jerry, that's not fair. And my answer is, I'm not trying to be coy or anything. That's what Congress has decided. And so what we're doing, we're preparing a return. We're trying to be correct. And you just can't deduct losses on a personal residence, and you can't deduct losses on a personal vehicle. But again, adjusted basis. I'm not saying adjusted basis is easy to calculate. What I am saying is there's a lot of material out there. If you're going to do it, you want to make sure you're adding those items that need to be added. And a home is a big one. The 1099-B, that's a document, and a lot of people will have it. It's attached to some type of brokerage statement. I had a client a couple months ago. He showed me his 1099-B. It was like a phone book. He's an investor, and it took me a long time to go through, and I did a lot of reading. Typically at the Vita site, it'll be a document, a one-page document, and when you're selling a stocks or bonds, it'll be reflected on the 1099-B. The capital loss carry forward, if you go to page Delta 22, it explains that. All you need to do is ask the taxpayer, hey, taxpayer, do you have your return from last year? And then what you'll do, you'll look at the return to determine if there's any carry forward, and you'll plug it into the software. But again, page Delta 22 does a great job explaining where that loss carry forward goes. And then if you have someone who sells stock, let's say in 2020, and they have a loss of, let's say, $20,000, they're allowed $3,000, and then the remaining $17,000 would carry forward to subsequent years. And so what that means is that would be used up in subsequent years. If the taxpayer dies, the loss dies with the taxpayer. It's not carried forward to something else. It just goes away. But again, that's capital loss carry forward. I've seen that a few times at the Vita site, and so you might want to take a look at Delta 22 as you go into your advanced training. A couple other things, capital gains distribution. It's a different animal than capital gains. The distribution, like for example, I had mutual funds. I still do have mutual funds. So what happens is that regulated investment company and the mutual fund company, they're selling capital assets. And what happens is you're a shareholder. So the gain comes down to you as a capital gains distribution, and it'll be reflected on the 1099 DIV. You simply plug it into the software, and then it'll appear on the Schedule D as in Delta. And you see a lot of capital gains distribution. Mutual funds are real popular. Okay, sale of a residence. And if you could, let's go to Delta 28, page D28. When you have a sale of a residence, I'm not saying this is complicated. I don't think it's complicated. I think it's a little bit involved. And I think some of the key things to do, what I do, you're going to do what you're going to do. But what I do is I have a publication 523 that I use, and it has a lot of good examples. And I will always ask the taxpayer, okay, you bought the house, you sold the house. Let's take a look at your settlement statements. And your settlement statements, I think they used to be called HUD-1s. I try to look that up, but I don't know if they're still called HUD-1s. But when you buy a home and you sell a home, you're going to get a settlement statement. And on that settlement statement, you're going to have information pertaining to the basis or the adjusted basis of the property. And then another thing, we talked about adjusted basis. When you purchase a home, a lot of people, they will do capital improvements or they'll do repairs. So for example, I did a repair a couple of days ago where a guy came, I had a broken lock, and he said, okay, Jerry, I'll fix the lock, but pay me lots of money. So I paid him lots of money, he fixed the lock, that's a repair. Capital improvement, when I moved in, I had a bunch of bushes surrounding my house. I'm thinking, okay, bushes are nice, but I want them to go away, and I want a nice fence to be installed. So I pay some guy a whole lot of money, and he installs a real nice fence. It's going to be there for decades and decades and decades. That's a capital improvement. That is what is called an addition, and that changes the basis of my home. So I purchased my home for a certain amount. I put in that nice fence, and that would be a capital improvement. I think probably the best way to describe this, I had a client couple, 3 or 4 months ago. She had sold a home that she owned for about 50 years. And I'm thinking, okay, well, we have to ask her a lot of questions. I got the settlement statements, and it was a very, very comprehensive interview where I tried to determine what's an improvement and what's a repair, because obviously the higher the adjusted basis, then the lower the gain is on the sale of the property. And so again, it's not complicated, it's just involved. So if you're going to do that for a taxpayer, you want to be spun up, you want to use the 523, and you want to conduct a detailed interview. And then you see about that maximum exclusion. This is the maximum exclusion, and in the Vita program, I don't think we do the reduced exclusion. You can read about it, but that exclusion, you have to meet ownership and use test, and that's a fantastic exclusion. But again, you're in Southern California, so you might have a senior who sells their home for maybe $900,000, and they take that exclusion, and their adjusted basis is maybe $100,000. they still have large capital gains. And so that's something, again, I think if you spend time interviewing the individual, it helps to be a homeowner, not required, but it helps because when you're a homeowner, you know, typically you know what a capital improvement or repair is. But my takeaway here is use Delta 28, spend some time before this Vita site's opening and tell yourself, do you want to do this? And your site coordinator should be able to say, okay, here are the folks that I want to prepare returns for sale of a residence. And the more you do this, the easier it becomes. But again, I think the takeaway here is I always tell people, this is the way I look at it. It all boils down to adjusted basis. Can you calculate adjusted basis correctly so you can reduce the amount of tax that the taxpayer owes? And you want to do it correctly. I'm going to open it up for a second here, and then we'll jump into the software. Any questions, comments? Nothing?
One comment. Once had a Vita customer, and we've got a maximum income. He came in with a Schedule B that had $1 million in transactions. He was a day trader. He lost money at it. But it was a big job just to get all that data down.
Was that a Vita site or AERP site?
A Vita site.
Wow. Okay. Yeah, I guess that's another thing. And when you're a site coordinator, sometimes we see these very involved returns, and we usually tell the person, look, this is going to consume a lot of resources. So what we'll do is maybe make some photocopies. We'll keep those secure, and then we'll have you come back in a week or two. But if you have 2 people involved in a return for 8 or 10 hours, as a site coordinator, I would probably say that's a no-go. I would say let's do it differently. We still want to help you, but we're gonna shut things down to help out one guy or one gal. But interesting. Yeah, that's another thing about the Vita program. You probably know this by now. It deals with income, and the general rule is, with the guideline, it's about 60,000. But again, that's not in cement. That's like in Jello. But you might have someone who has net worth of 2 or 3. I've seen it before, $2 or $3 million. But net worth is not a consideration. It's income. So. All right. Has anybody ever done this before?
On those big brokerage reports, there's usually a summary at the end of each class, short-term, long-term, reported, not reported. It provides all the information you need to file the return.
Yeah, good point. Yeah, and some of those brokerage statements are very well done, and some of them you'll look at them and say, okay, I can speak and I can read and I can write English, but I don't understand what they're telling me. So yeah, it's yeah, that's just the way it is. That's just the way it is. And a lot of people think that a 1099-B, they're all made alike, they're all identical. And based on my experience, no, they're not. And so you do have to look at them. You do have to read them. And when I have the taxpayer sitting across from me, I'm not embarrassed about saying, I don't know what this is. And a lot of times I say, well, you should know that. You're a tax preparer. And I tell them, I don't know this. Tell me what you know. I'm going to be able to help you out. Okay, anything else about sale of a residence?
Hey, Jerry, follow-up question on mileage.
Mm-hmm.
If, let's say, an Uber driver, is the mileage going to pick up the passenger deductible item, or the mileage during the transport of a passenger?
Yeah, if you're driving from point A to go to point B to pick up a passenger, that's business. That's like me when I leave my house as a self-employed individual, and I have a lot of currency that I've been given by my clients, and I'm going to the bank to deposit it. That's a business trip, and that's a fully deductible item. So the short answer is yes. Yes.
Okay.
And here's another thing, and I've had this discussion with Uber drivers and Lyft drivers. They'll explain a bunch of stuff to me, and I tell them, look, I don't know all there is to know about Lyft or Uber. I've taken one Uber in my life, but this is what I do know. I know what a Schedule C is, so I'm going to ask you about your income and your out-of-pocket expenses and however you've accounted for that. Sometimes they'll throw a bunch of stuff at you and say, well, it's taken out of my check. I'm thinking, okay, well, it's taken out of your check. That means you paid out of pocket. And that's why that publication in 334 is so important, where you can educate that young Uber driver and they'll say, okay, I got it. And then what happens, that's going to happen, that'll help them the next year and the next year.
Right, and a follow-up also on the toll road. The toll road is included on the K for Uber drivers because the passenger pays for that.
And what I do, because everything's different, every company is different. People will say this and say, I'm interested in your income. I'm interested in your expenses you incur to generate that income, and I will prepare a Schedule C for you, because I cannot master 500 different types of documents. And that's why it's so important to ask the taxpayer, explain your business to me, explain your income, your methodology for accounting for that income, and your ordinary and necessary expenses. Because again, you will bump into people, they will tell you stuff and say, I don't know what you're talking about. And that's why you got to boil it down to an income statement.
Yep.
Let's move to adjustments to income, just a couple things. This is pretty basic stuff, but I think it'll help you out. A lot of young adults, when you tell them a certificate of deposit, and they go, what is that? Well, a certificate of deposit is you put money in a bank, you sign a contract with the bank. When you break that certificate of deposit or that contract, you're going to pay a penalty on early withdrawal. That will usually be evidenced on that 1099 INT. So if you have that early withdrawal penalty, you just plug it into the software. I think that's one of the questions on the test. The 1/2 self-employment tax deduction done automatically for brand new self-employed people. They're really confused sometimes in self-employment tax. So you explain to them, you got FICA for wage earners, and then back in the 50s, the Self-Employment Contributions Act was enacted by Congress, and that's for self-employed individuals. And if you meet certain rules, and you have to pay self-employment tax, which is generated automatically after you populate the Schedule C. And then student loan interest deduction, the max is $2,500. Typically, the taxpayers will come in with an information return, and if you plug in more than $2,500, the computer will limit it to $2,500. And then there's a phase out based on income, but the computer will do that. Jury duty pay. If you get jury duty, step number 1, you got to report that pay on your return. Step number 2, if you submit that check to your employer, because typically your employer is paying you while you're on the jury, then you simply go into tax layer, you go to deductions, you bounce down to adjustments, and then other adjustments, and you plug in your jury duty pay that you submitted to your employer. And so what that does is that essentially nets it out. On the top part of Schedule 1, it'll show jury duty pay, and then in the adjustments on Part 2, it'll show the amount that you submitted. Okay, so let's do this. Let's get into. Give me just a moment here, and I'm gonna open up the software here, and I can entertain any questions if you have questions when I do this. And Steve, if you have any chats, if you can bring those up.
Let's see. Yeah, nothing on the chat that would. There was just a comment about taxpayer information should flow from Vita to AARP and vice versa, but we need to see and find out if that's going to be the case.
We talk about the global carry forward.
Barbara, is that what you're referring to? If you can unmute yourself, Barbara, is that what you're referring to?
That's what I'm referring to. Yes, the global carry forward. I was told by tax layer in a presentation that it would carry forward between ARP and TC and Vita. We have never confirmed that.
Okay. All
right. I believe that's the case, and this is something that we're going to get more information on. December 15th, there is site coordinator training, and I believe some of you are going to go to it for the Orange County United Way, and we'll probably get the answer on that one. Okay, so let's see here. Steve, I'm going to see if I can open this up and show you let me know if you can see the screen with the software here.
We're still not seeing it. But...
Yeah, give me just a moment. I'm doing my magic, as they say in Hollywood.
Okay.
Okay. And I'm still not seeing it. Steve, maybe you can do it. Can you bring up Link and Learn? Do you have the ability to do that?
Link and Learn. Okay, I do.
Let me try it one more time here. Okay, Steve, I think I got it here. Can you see my screen now?
There you go. Yeah.
Okay, just a couple things. And of course, if you've been in the Vita program, then you've used this extensively. And so you can see up here, 2020, this is the year that's posted. And as I said before, this is a work in progress because there's a number of things that have not been added, i.e., when you try to generate a 2020 return, the 2019 will be generated, and also the state returns are not yet loaded. And so again, for certification purposes, you can use this particular program because again, when you do certification, you're given a scenario, you prepare the scenario, and then you answer questions on the test. But let's go through a couple things right here. Let's go to our, we know what the W-2 is, we saw that last week. Here is your 1099-R that we spoke about. And we had a question about the 1099-R and the simplified method. And I forget who that question came from, but if you remember, the 1099-R will have a gross distribution, and then where it says you need to calculate your taxable amount, then what you do, you would click there. Well, let's fill this in first. You would click there where it says click here for options. And then it should open what is called the Simplified Method worksheet. This public safety officer distribution, that's typically for your law enforcement folks, some of your firefighters, and you do see that from time to time where they're not paying income tax on all of their pension because they've got a part of it is for disability. Here's your simplified method, a whole bunch of questions. I'm going to hit continue and show you the screen that you would see from the publication 4012. And then I'll mention this because I think we talked about this on the break. Someone had mentioned there's called a, correct me if I'm wrong, the Bogard worksheet. Did I get that right?
Yes, that's
yes. It's called the Bogart tool, and somebody in the chat put in the actual link.
Okay, so that's something that you can take a look at. And all that tool is, as I understand it, it helps you to get through this simplified method worksheet. So what you're doing, if someone has basis or cost in their annuity, then when they recover that, only a portion of the distribution is going to be taxed. And so you can see here's the various questions that you're going to answer. And again, you're going to follow it lockstep. Joint or survivor annuity. Again, that's when you sign your spouse up. And then age at the start of the annuity. And so that means you're going to know their birth date. You're going to have to determine what their age is when they started to receive their annuity. Annuities, if they started in 2020, maybe they started in March or April or May. And so you want to get that right. But you just want to plug it in. And then amount previously recovered. There are different ways. The way that I've used is tax returns from previous years. Okay. And then Steve, I did send you the tax practice lab return for a taxpayer by the name of Tomas Silva. Can you send that out to everybody? And then what they can do, they can work it. And then next week, that'll be the first thing we jump into. We'll review that particular return, which has a Schedule A, Schedule C, and Schedule D.
Okay.
That, Steve?
Yes, I got it.
All right, great. And then also your non-taxable distribution, this would be the one, again, let's see if I get this right. Here we go. Qualified charitable distribution. And then we had one of our participants talk about that. And if I remember correctly, she said it's a great thing because it helps out charities and the money goes directly to the charities. So that's where you would check there and then continue. Let's go to the Schedule C and just point out a couple things, kind of revisiting that Schedule C. Most of you probably work with it. That young volunteer that we have, the high school volunteer, again, you should probably keep in mind, this may get a little bit involved, but it's not complex because all you're doing is determining the income that needs to go on the return, those expenses that need to go on the return, and then the difference. And you can see right here in large font, that tax layer displays all of this. And so if you're new or newer or forgot, the pencil means you're going to edit the garbage can, the red garbage can, you're going to discard all of your data. And I will tell you, I've done this time and time again. I'm all confused or the program's confused or something's confused. I just go and I dump it all and I start all over again. I've done that from time to time. Here's your Schedule C. You have basic information. A lot of times, like for example, my business, my name is Jerry, last name is Muir. I'm thinking, I don't need a business name. And so on my Schedule C, I just leave it blank. But if you have a business name, let's say I call it Jerry the Taxpayer, then I would type in my business name. You're not going to have employer IDs typically. That's typically for folks who have employees. But if you do, you plug it in. Your business type, a lot of people get really excited and wrapped around the axle. They spend hours looking for the business code. Well, the world will continue to rotate on its axis if you get the business code that's not quite right. Put it up. You're going to ask the individual, hey, what do you do for a living? What type of work do you do? And you're going to go ahead and try to get as close as you can. But guess what? If you're a little off, the world will continue to rotate. In this case, let's just pick anything. It'll populate here, and it'll tell you about the type of business. I've literally had volunteers spend 20 minutes on that site, and I'll come up to them as a site coordinator and say, look, I appreciate your efforts. Let's move on. Okay, questions about the business. As far as I know, we only deal with cash method in the Vita program. And that's defined as you're going to report your income when you receive it or constructively receive it, and you're generally going to deduct your expenses when you pay them. That's essentially what the cash method is. And if someone says, I'm an accrual taxpayer, I'm thinking, okay, we can't help you here. We don't teach that. You don't deal with inventory, so you might want to, I usually just leave that alone, or you can check not applicable. Material participation, it's going to be pre-checked for you. And again, if they don't materially participate, which means they're running the business, they're engaged day to day, we can't help them in the Vita site, but typically they're going to be materially participating. And then down here, it talks about the qualified joint venture that would be for a taxpayer and their spouse. And then that way you're going to have two Schedule Cs that'll be generated. I haven't worked with too many ministers. Unfortunately, I've audited ministers before and gave them bills, but as a practitioner or a Vita volunteer, I've never helped out a minister. And Fred, I think the priests at St. Killian's, do they take advantage of the program, or do they go somewhere else? I don't know.
I have no idea.
Yeah. But I mean, if one of the priests needs assistance,
They're not on our list. They're not on our list.
Oh, okay. All right. Well, if they ever ended on the list, I'm sure we could help them, right? If they, are, I don't know what their income is. Okay, so we talked about income. So when you click here, and this is really important, especially for people who are brand new to the program, and they get confused because they think, well, I didn't get a 1099 NEC, I didn't get a 1099 MISC. And I always tell people, put your Section 61 hat on. Tell me about all of the income that you received in 2020. And then I'll have a pencil and a piece of paper, and we'll have that discussion because again, all of your gross receipts are going to be reported in this line. And we don't do returns and allowances. Statutory employees, I don't think we see them in Vita. That means someone, they're issued a W-2, they're a wage earner, they're allowed to report their income on the Schedule C and take certain expenses. We don't usually see that. So anyway, I'll plug that in, and then I'll go to expenses. And what I do, people will give me a laundry list of their general expenses, and then we'll have that discussion. And sometimes I'll tell them, like I had a gentleman one time, he says, Jerry, I've got a phone, I use it for my business. I'm thinking, how many phones do you have? He goes, just the one. I said, you can't deduct it. So typically you're going to see things like down here, you're going to see office expense, you're going to see perhaps rent, supplies, taxes and licenses. You cannot deduct federal tax. That would be, like, for example, I had my locksmith came the other day at a broken lock, and I asked him, hey, tell me about your business, because I'm real curious. And he says, well, I have to have a license from the city, maybe the state, and then I have to pay some type of liability insurance. So if he was going to put his license down here, maybe he has a vehicle that he uses exclusively for his business, this would be the DMV taxes. So that's where that would go. And then we don't deal with employees in the Vita program. So if you have someone who's self-employed and then they have an employee, we can't help them in the Vita program. And then let's go to other expenses. Other expenses, you're going to see a laundry list of things. This is an example of a locksmith. And so tools, these are minor tools, things that last less than a year, work clothes. In my locksmith, he had a special outfit. It looked pretty cool. He had special padding because he had to get into a particular position. That's deductible. Then bank fees, he had a bank account and he paid the bank. So those are other expenses that you're going to see on the Schedule C. And just remember, they have to be ordinary, necessary. They've got to be reasonable. There has to be a business purpose. And the one example I usually give from time to time is you have a self-employed individual. They hold a birthday party for their 9-year-old daughter. They get the bouncy house. They have Bozo the Clown show up. They have cake and all that stuff and music. And then the guy invites a couple of his clients over. That's not an ordinary necessary expense. That's a personal and family living expense, which is not deductible. And there's no allocation there. The primary purpose is to have a great birthday party for his daughter, not deductible. Let's go to the business use of a vehicle. And in this case, what I did is I explained to the software, I've got a vehicle that this is my locksmith. I used him as an example. So he's got a vehicle he uses exclusively for business. He has another vehicle, the date he put it in service, and then down here, business miles, and that would be driving around, visiting clients, repairing locks, things like that. He had no commuting expense because he's not a W-2 wage earner, and then other expenses. And then down here, you probably remember this from last year, you're going to indicate whether or not they've got another vehicle. And that's why I ask people, how many vehicles do you have? I think there's a rule, if I'm not mistaken, in the publication 463, if you have more than 5 vehicles and something else kicks in. And then down here, I've had people get wrapped around the axle on this one. I tell them, look, everybody has evidence to support a deduction. You've got your DMV bill, you've got your gas bills, you've got your repair bills, you buy tires for your vehicle, and that evidence is either in an electronic form or a hard copy form. And written is either electronic or hard copy. So what I do, I typically check, and we move on. And then what will happen is the computer will look at the business miles and then calculate that at 57.5 cents per mile. And if you're self-employed, that's a pretty good deduction, the business miles. Let's go to our capital gains. And this is something, it's pretty easy, if I could use that term. And here's an example where all you have to do is you're going to get that 1099-B. You're going to look at it. Most of them are going to be easy breezy. You'll be able to determine when they bought the stock, when they sold the stock, and then the number of shares. And you're just going to plug that in and the dollar amount. That's all you're going to do. And you can see right here, this box where it says Cost basis reported to the IRS, cost basis not reported to the IRS. Didn't receive a 1099-B. I have seen cases where people will come in. I had a discussion with a young lady last year, and she says, "Hey, why can't you do my return?" I said, "Well, I know you sold some stock, but I don't know what the basis of your stock is, and your 1099-B doesn't explain the basis." She goes, "Well, can't you just figure it out?" I said, "Well, no, I'm not going to figure it out. What you can do is you can go to the website, i.e. the internet, and there are cost basis of stocks going back about 100 years. Sometimes you have to pay some type of subscription to it. But you do the legwork, you bring in the cost basis, and I'll go ahead and finish your return." But I would avoid that. Up to you. At my site, I instruct my volunteers, if they don't have the cost basis to the stock, have the discussion. I'll try to help them out. I'll give them some guidance, but we're not going to sit there and guess. We're just not going to do that. There's a way to find that out, and sometimes you got to make a call, or maybe you got to go on the internet. But typically, it'll be reported on the 1099-B as in Bravo. And then there's a whole laundry list of things here. Sometimes you're going to use these, and sometimes you're not. Your publication 4012 does a really good job explaining all these other items. I think that's about all we need there. Let's go to the Schedule A as an alpha, point out a couple things here. Medical and dental expenses, we already talked about that. Mortgage interest. You're going to see the mortgage interest here where it says enter interest and points paid. And so you open that up. Typically it'll be from the 1098. So we open that up. The name of the financial institution, the name of the amount of interest paid by the taxpayer. And then if they paid points and they want to deduct it in full, then they can go ahead and enter that data there. And then sometimes you're going to have taxpayers, they've paid off their home, good for them. So they'll probably only have real estate taxes that they're paying. And then of course they also most likely will pay some type of homeowner's insurance. Homeowner's insurance is not deductible on a tax return. If you have a rental property and you're doing that military module and you're paying homeowner's insurance, then yes, it's deductible on the Schedule E as an echo. Here's your real estate taxes, typically from that document from the county assessor's office. Most people know how much they pay in real estate taxes. A lot of people pay electronically, and so there's a way to retrieve that data if they have forgotten. And I don't know what you guys do, but when I'm at my Vita site and it's really quiet, i.e. last year before COVID, and we had a taxpayer who had some issues trying to obtain these documents, we would spend the time, we would sit down with the computer, with the taxpayer and help them out when things are slow. Okay, private mortgage insurance down here, that deduction. Let's go to the taxes paid. This is personal property tax, and you have a tab here that says sales tax. So keep in mind, if you have someone who wants to take the sales tax deduction instead of the state income tax paid, they would go to the sales tax worksheet. I think I've only done this like 2 times at the Vita site. And you can see where it asks for a zip code, that would be where they live. And then also you're going to put in the number of days they were at the zip code. And then you can plug in the sales tax, or you can put in the dollar amount that you actually paid. So this is where you would find that. And then one of the attendees talked about the sales tax deduction calculator. I tried this the other day. I think it was a broken link, if I remember. But anyway, this should be up and running. And this is how you go to your tax deduction, your sales tax deduction. And so think about what you do in your life. You go out and you buy stuff. Chances are when you buy stuff, you're paying sales tax. Unless you buy that gallon of milk at the grocery store, that's one of the items that is not subject to sales tax. I think baby formula, there's no sales tax on certain types of, you buy grapes. But if you're buying cigarettes, whiskey, and wine and beer, you're going to pay some sales tax. Okay, a couple more.
At the AARP site, we always enter in the zip code because we don't know if the sales tax is going to be greater than the state income tax they paid. So we always enter that number and let the software calculate how much sales tax. We don't enter because it knows what the sales tax is based on the zip code.
Good point. Good point. Okay, so we talked about the Schedule C a little bit. We talked about the capital gains. Let's go to our adjustments to income. And
not all people buy things at their home zip code.
That's right. That's right. Yeah. And keep in mind, if somebody buys a big ticket item and they bring it back to California, they have what is called use tax. So now in this example, what I did is I had a taxpayer who paid $10,000 in interest. Now what will happen is the software will only recognize $2,500. And so it's up to you. I usually key things as I see it on the document, but in this case, the software is going to correct the amount or only allow the 2,500 that's allowed. Let's go to this one. This is the area where you can enter information for your payments, and this would be for your federal payments. And so if someone is making estimated tax payments, typically what they're going to do, they're going to make 4 estimated tax payments during the year. And so if they make those payments, and hopefully they do, and what happens is that meets their obligation. The general rule is they're paying 90% during the year. But that's important. And when I meet with a Vita customer or a new client and they're brand new to self-employment, I spend a lot of time on estimated tax payments because I've seen the horror stories where people end up spending all their money and then they don't have enough to pay tax at the end of the year. That's, again, typically for the new folks. Let's see, what else? I want to show you the jury duty thing. So let me show you the jury duty thing. So here are adjustments to income. We know we report our jury duty pay in other income. So let's say we've got that jury duty pay that was relinquished to the employer. So I come down to adjustments. I come down to other adjustments. And then I go to jury duty pay. And this is the adjustment. I've already reported the jury duty as income. Now I'm taking that adjustment. And let's put a mat here. And that's how that will appear. And then let's go to our form. Let me show you this. And I think, I forget the attendee who mentioned this, but I tried to generate a PDF last night. I was unsuccessful. But what I can do, I can generate this screen right here. So you can see I'm in the 2020 program, and right now the 2019 shows up. So for me, it's like, I've seen this before for many years. That's just the way it is. But this will get corrected because it is a work in progress. So I think you have to be patient. And you can see, let's see. Let me just show you one thing here. Let me show you page 3 on this. And so if you might remember this from last year, your adjustments to income and your additional income. This is the Schedule 1 that will report all those additional items, i.e. your Schedule C, your unemployment compensation. And right here on line 8, if I had entered jury duty pay, which I should, it would show up here. Your prizes, your awards would show up here under other income. And then your adjustments to income, typically, this is what I've seen at the Vita site. I've seen the educator expense, which is for your school teachers. I've seen this is for the military module, the business expenses for reserve component military personnel. And then I've seen, of course, the deductible part of self-employment. We know that if you're self-employed. Penalty on early withdrawal, that typically appears in your certification year after year. And then I do see alimony paid from time to time. This is the adjustment for the old rules. And then IRA deduction, that's still around. Your individual retirement arrangement, you can make a contribution and if you qualify, and then your student loan interest deduction. So if you would, Steve, the IT guy, will send out Tomas Silva practice return. If you can go ahead and prepare that. And then what we'll do next week when we first open up, we'll go through that return in detail, the Schedule A, Schedule C, Schedule D, and we'll talk about that particular return. So with that, I'm gonna stop talking and answer any questions if I can.
I have a quick question.
Mhm.
I was gone for just a couple of minutes near the end, around 11:30. Did I miss any discussion about what was it? The rebate if you did not get the money from the government for COVID relief?
You did not. The recovery rebate credit, we're going to talk about that. We'll do that on a return, but not today.
Okay. All right. No problem. Thank you.
Thanks, honey.
Okay. No more questions? All right, folks. Then we will see you next week for those of you who want to show up. And we appreciate your time and effort. Steve, thank you. Fred, thank you. And thank you for all the questions.
Yeah, thank you, Jerry. And
Thanks, Jerry.
St. Killian volunteers, if you can hang on for like maybe a minute or two, we have something that we need to relate to you. So again, for those attendees, see you next week. Thank you.
Thank you, Jerry.
Okay, take care, everybody.
Thanks, Jerry.
Yeah.
Great questions.
Thank you,
Thanks,
Jerry.
Jerry.
Thank you, Jerry.
Thank you, Jerry.
Thanks.
Thank you. Bye-bye.
Bye.
Take care.
Hey, guys.
Steve, do you need me? Otherwise, I'm going to go see what.
Yeah, go ahead. Jerry, you're free to leave. Thank you. I'm just gonna mail requested for the St. Killian volunteers to just stay put for like a minute or two. But Jerry, you're free to leave. Thank you again, and I'll talk to you. One of these days in this week.
Okay. All right. Take care, everybody. Bye-bye.
Yeah, have a good one.
Bye.
Thank you, Jerry. Right here.
All right. Let's see. Let's give it a few more seconds. There's
35.
There's 35 more people here, so I'm not sure if these are all actually St. Killian people. So
how many volunteers do you have for St. Killian?
Fred, are you there?
Yes, I'm here.
We usually have Fred. At the most, we have about
35, 40.
45.
Yeah. Yeah, the more the merrier, of course. Anybody else that are not aligned with any site are invited to join us.
Which days of the week do you do it there, or planning to?
Saturday.
Only one day a week?
Yes.
But it's virtual. It's like it's going to be virtual.
Yeah. So Yvette, if we are doing virtual on Saturdays, but throughout the whole week, actually, we can have the volunteers prepare taxes at their own time and convenience at home. So it's not limited to just the Saturdays. The Saturdays is just a designated virtual day for us.
That is a drop-off.
Yeah, the
Drop off, pick up.
Yeah,
but taxes are being done
in intake. Yeah.
Throughout the days of the week. If you are assigned tax preparation.
Okay, because I currently work in Mission Viejo site. And so I'm curious, how are you setting that up? The people, the volunteers will not do face-to-face talking to the taxpayer. The taxpayer is just going to drop off the filled out form, the intake form, and their documents?
Yes.
No, the intake's the intake process will be done in person.
Oh, good. Okay.
Yeah.
And would that be on a Saturday or?
Yes.
Yeah. Okay.
Saturday,
yeah. I mean, the general plan, and correct me if I'm wrong, anybody's right. You come in, you do your intake, then the items are scanned. We kind of scanning them into to a OneDrive, and then that'll be fed to the preparers during the week. And then when it's all done through quality review, there'll be another Saturday where they'll have to come in and do like the signing and everything or approval to the e-file.
And if the taxpayer
get their hard copy, right? Get their hard copy of the return.
And if the taxpayer has any questions, he calls the client on the phone.
And how have you tested this yet? I'm curious.
Yes, we did.
scanning and all that.
Quasi last year. We did it. Yeah.
That's what we did last year.
Oh,
Or
okay.
this
Okay,
year.
thank you.
Yeah. So yeah, Yvette, if you we'll have you we'll have Fred contact with you and see if you can be part of a St. Killian team. That would be great. The
Are
reason
all these 31 participants for St. Killian volunteers?
31.
Yeah.
Okay, well that's good.
I'm not sure. I'm not sure because I'm not familiar of some of the names.
Yeah, some of the names. There's some new people that are volunteered from Compostela, as well as other volunteers that were not aligned with any group.
If they stay on, they're required. We require them.
There's
guys,
one participant. It says owner. There's no name. So
Yeah, I'm Violeta de los Santos. I'm new volunteer here, so I don't.
Okay, so
Okay,
is that the owner? Is that the one that has
that
the
was
owner?
Galaxy. That was the Galaxy one.
Yeah, that's the Galaxy.
Yeah, the one that has owner.
Owner's still on mute.
Yeah.
What's the difference?
All right, guys. If that's the case, what I'm gonna do is I'm gonna start the recording now, because now that way this is gonna be just for St. Killian, okay? I'm gonna